way down there.
Expensive to bring in Chinese goods from Asian countries than it would be.
So
from,
what, okay, yeah. So what do you think the delta is going to be there between coming in from China versus coming in from Canada or Mexico?
Yeah, absolutely. So I mean, you have no 10% tariff on Mexico or Canada, right? And you got 10% on every country in the world, and it's going to be more expensive to reroute those Chinese goods into Asia countries and back into the United States. And so what you're going to see is that the supply chain is going to come closer to home. This is what Trump's trying to do, and I think the Vietnam deal was the first one. We expect over the next couple of days that we're going to see an India deal that's shaped very similar to that.
Dan, we're going to leave it there. Thanks so much for your time.
Great, thank you.
Okay. Coming up, some more reaction to President Trump's mega bill in the House. Maryland Governor Wes Moore has called it a nightmare for working families. He's going to join us next to talk about Squawk Box. We'll be right back after this.
Come and make it count.
Welcome back to Squawk Box. As Republicans work to pass President Trump's mega bill in the House, our next guest has spoken out against it, calling it a, quote, nightmare for working families. Joining us right now is Democratic Governor of Maryland, Wes Moore, in the House at the table. Good morning to you, sir.
Good morning. Good morning.
This thing seems like a fait accompli. I mean, Hakeem Jeffries is speaking. We'll see how long he can keep that going. But when he stops, it sounds like this is going to happen. You have been very critical of it. In some ways, by the way, you're in the same camp with Elon Musk about parts of this.
Yes, I am, because I think in many ways this bill makes this country less safe, it makes this country less healthy, and frankly, it makes this country more debt-ridden. And I have real problems with that, because I think that's going to fall on the shoulders of all of our states to be able to support the people in our individual constituencies. I mean, we're around our state all the time, and I'm out there talking with folks in the Eastern Shore. We've made the largest investments in rural healthcare in Maryland, arguably in 2 generations that the state has made. But now, those are the same folks that are now about to lose $250 million in rural health care. That, I'm speaking with folks, at the Manna Food Center in Gaithersburg. And what we're about to see with SNAP, this is going to be the largest cut to food assistance that we have seen in our nation's history. And that is going to hit the over 360 food centers, food distribution centers that we have in our state. So we're gonna receive the brunt of this.
Do you believe the CBO estimates in terms of what this is going to cost? The reason I ask this is I would have thought, we've talked about this, that the debt market, if it really believed, I mean, if investors really believed this was going to be a demonstrable problem, you would have seen treasuries move in different ways, the dollar would have moved in different ways, and for whatever reason, despite all the people seem to be frustrated about the addition of the debt, the bond market hasn't moved. You, by the way, you used to work at Citigroup.
That's right.
We
study the 10-year yield and what that means for our economy.
What do you think of that?
It's complicated, because I think one thing it's not picking up on is who this is going to directly impact. And I think about this in context of what we've done in the state of Maryland, right? Where in the state of Maryland, we've shown that there is an alternative where in our state, we went and actually reformed the tax code for our state, where I said it did not make sense to me that someone who was making $30 million a year was paying the same in taxes as a family that was making $300,000. So we actually did a reform of the tax code. We gave the middle class a tax cut, where 94% of Marylanders got a tax cut. And I asked those who had much more to invest a little bit more to be able to sustain our economic growth. And if you look at what's happening in the state of Maryland right now, we've gone from 43rd in the country in unemployment to now having amongst the lowest unemployment rates in the entire country. We've raised the minimum wage and actually stopped disincentivizing work. We've increased housing inventory and helped to speed up the process and go faster so we can actually create more pathways to wealth. And it's actually working. Where Maryland's population is growing, Baltimore's population is growing for the first time in a decade. And so I just believe that sometimes the bond market is not catching up, because they have the ear of the investor, but not understanding what's happening to the middle class and the working class families who this is going to impact.
The unemployment rate in your state is 3.2%.
Yeah.
That's below the national average. I'm just wondering, as governor of Maryland, what do you do then to offset the cuts that will come to SNAP benefits, the cuts that will come to Medicaid?
I mean, it's tough, because Maryland doesn't, and there is no state that does have the coffers to be able to make up for this. What we're fundamentally seeing is there has always been a historical relationship between the federal government and our states in the way that we are protecting the people. And frankly, one thing I've seen for the first 6 months is, of the Trump administration, the Trump-Vance administration, is that the relationship between our federal government and our states has been severed. The communication, oftentimes, between the federal government and our states has been severed. What we are now seeing with this bill is that the relationship between the federal government and its people has actually been severed as well.
So a lot of the messaging from the administration about this bill is, look, if you are not taxing tips, for example, and things like that, that's going to create growth and it's going to help the bottom, right? But that's the message you hear.
Yeah.
On one end, the message I'm hearing from you is that whatever's happening over there is not going to make up for the SNAP issue over here.
And also, I mean, listen, there are some aspects of this bill that I don't think are bad things, and I think actually, are important. I think what they were doing around the standard deduction, actually, I think is smart. In fact, in the state of Maryland, we did the same thing. We doubled the standard deduction. within the state of Maryland. That's a smart move to spur economic growth. I think the things around the child tax credit are important, even though I would have differences on how I would do it. But I think making adjustments to the child tax credit is important because it's one of the best poverty fighting tools, particularly for children, that we actually have inside this country. But what this bill is also, it's the largest consolidation of wealth in our nation's history. It's essentially undercutting what we are seeing for any supports for the people at the bottom on this, so we can have that large consolidation of wealth. And I find it ironic that it was J.D. Vance who cast the deciding vote on this, a person who repeatedly talked about his mama and how she benefited from the same programs that he just voted to gut.
But just to play the other side, I mean, SNAP benefits aren't just being eliminated for certain people. They're being eliminated by associating them with requirements like work requirements, immigration status requirements. These are tough choices that need to be made.
Yeah.
Not everybody can get benefits.
Oh, I agree.
So, I mean, do you disagree with attaching certain conditions to receiving benefits?
Not
in
at
order
all.
to get them?
But I do think there's an overstating about what that means and what that looks like. Because the vast majority of people who are receiving these benefits, these are actually working families.
Right.
These are people who are already working, but who still need benefits because they're still not making enough money to be able to benefit them and their families. The federal minimum wage right now is what, $7.25? I mean, so you're forcing people to essentially become the working poor. That the people who are receiving the benefits are people like seniors. It's veterans. So I think that while I completely understand that we don't, and I don't believe in quote unquote giveaways, I also know this: the vast majority, the overwhelming majority of people who are receiving these benefits are people like our seniors, are people like our working families, there's people with disabilities. And I think we just have to be we have to have values that drive our decisions.
We're going to run out of time, but before you go, I have a question for you, talking about giveaways. Here in New York City, a place where you also used to live and used to run Robin Hood, a great charity that's done enormous things for this city.
Yeah.
What you think of the race for mayor here between Mamdani now and Eric Adams? I think those are really, realistically, the only two choices on the table.
Yeah. It's fascinating because I have not followed the race as closely or the policy as closely.
I love you and I don't believe you.
No, and it's true. I really haven't. But the thing that I have followed is the narrative, because I think the narrative around affordability is right. And I think that honestly, it's the same thing we pushed in Maryland, where the way we approach it is I focus on pathways to work, wages, and wealth. And doing things like decreasing the unemployment rate, increasing the minimum wage in the state of Maryland, and creating more housing inventory.
Okay, but that's where I was going to go with it. So the distinction, though, between what you're talking about, I think we're all in agreement there's an affordability problem in the city of New York. We can diagnose the problem. The question is, what is the solution to that?
Yeah.
I would argue if you want to have lower rent, ultimately you need a lot more housing. You need
It's
a lot
more
more
inventory.
supply.
That's
you need,
exactly
you
right.
need the inventory.
That's exactly
It's
right.
not going to necessarily come, I don't think, from freezing rent.
No.
I mean, I think we've seen that story happen, and that goes to the Mamdani question of whether you think he's the right person for that job,
No.
right? And then on the other side, you have Eric Adams, who arguably, by the way, I think is actually the city has done it. Just look at the city numbers are pretty good.
Yeah.
And yet, then there's a situation where I think there's a lot of New Yorkers who say the man, for better or worse, or not for worse, is being held hostage by the White House, given this sort of unique, weird settlement situation. And what do you do about that?
Yeah, I think the way you increase affordability is you have to increase inventory. It's the reason that in Maryland we passed the most aggressive housing package in Maryland state history of any governor in Maryland state history. It's the reason that we have used executive action to be able to make sure that we can go faster. That I said, I want our state. We've got to stop being a state and a collection that does no and slow and get to yes and now. Build faster. Create great emergency inventory, because this is a basic supply and demand equation that I think we completely miss on, and so capping
Okay, so
that.
given that, if you were living here, who do you pick?
God, I don't live here. I don't know.
He's a
You know what I
broker.
If I was living here, you know what I'd pick? I'd say move to Maryland.
Governor Westmore, thank you for coming in this morning. It's very good to see you.
It's great to see
Appreciate
you
it.
all. Great to see you. Thank you.
Coming up, travel stocks in focus as airlines get ready for a crush of passengers this holiday weekend. We will talk about what investors should be watching, and we're continuing to monitor the House floor in Washington, D.C. Minority Leader Hakeem Jeffries still speaking
Still going at it.
President Trump's tax and spending bill. He's been going for
It's looking
more
like a
than
Cory
2
Booker
hours.
situation.
He intends to take his sweet time, as he calls it. Squawk, be right back. Airlines bracing for a busy 4th of July holiday weekend with 18.5 million travelers expected from this past Tuesday through this coming Sunday. Joining us now on the state of the sector, Stephen Trent, Citi airline analyst. Stephen, great to have you with us.
Thanks for having me.
Fuel prices are lower, but there's still pressure here on ticket prices. Why?
So we still have uncertainty in the economy. People and businesses don't exactly know what's going to happen with tariffs. So that is putting some pressure on certain segments. I would say the most discretionary travelers out there are maybe a little sketched. So within the U.S. airline sector, domestic mainline has been a little bit soft, but other segments continue to look very good.
At the same time, airlines have been running much more efficiently and with much more discipline. They've already cut capacity quite a bit going into this sort of slowdown that we may see unfolding here.
Absolutely, and I think that's definitely going to help. And if you look at what happened last year, sort of early 3Q last year was a bit tough. We had a little bit of a mismatch in terms of capacity here in the domestic market. The group acted aggressively. They cut. You saw a nice unit revenue bounce as we looked into the end of the year. And we're constructive that certainly on the network airline side, they are still well positioned to have a bounce as we head into the back half of this year.
Would you book out of Newark? That's the real question I have. I'm not joking.
Newark has had improvements. The runway stuff is done. They're back to, I believe, 34 departures an hour. They got down to 28. So there's now less capacity there. You can't deal with the weather. If you get a thunderstorm, it's impossible to predict that stuff. But yeah, I would book out of Newark.
I have a separate news you can use related question, which is all of these guys have effectively depreciated the value of your points, right? It continues. And it used to be that those were considered a liability. Do you consider them the same kind of liability anymore? mean, you actually math out what that whole loyalty systems even look like?
Yeah, look, the loyalty system for the airlines and for the financial partners is really good. The remuneration from those programs continues to grow. And if you're a network airline, you really have an attractive pool of customers, relatively wealthy people that demand global capillarity and spend on these cards, not just for buying tickets, for buying groceries or whatever they buy. So a little bit of depreciation of the points is really not going to cause a lot of pain because people are still using the cards. And that remuneration grows, that's working capital tailwind for the group.
Under this president and this administration, do you think that there would be more mergers allowed? We have this United JetBlue alliance, which sort of it's not a real merger, but it sort of looks like part of one. I assume that one of the reasons they haven't done a full merger is because the view is that maybe Washington would say no. But I don't know what you think would happen over the next couple of years, given the deregulatory sort of aspect of the way this administration has spoken about things.
Yeah, that's a great question. I mean, I certainly think, if we were 20 years ago and you still had a lot of the old airlines that no longer exist, US Airways, Continental, Eastern Airlines, Northwest.
Yeah, there's not a lot left to merge. I'm just saying, but there are a couple.
Yeah, true. So outright mergers under that context is going to be tough. If you're one of the big four, it's going to be a little hard to see how regulators are going to let your market share go even significantly higher than it is today. But soft stuff, alliances, I would say all else equal under this administration, yes, you're going to have maybe a somewhat higher probability than you would have in the last administration.
Stephen, great to see you. Enjoy your 4th. Stephen Trent.
You too.
Coming up, top stocks to watch ahead of the opening bell. We'll bring it to you, including a massive partnership between Oracle and OpenAI. Don't go anywhere. We got the jobs number. We got the big bill. We got so much coming up right here on Squawk. take a look at the futures. Beautiful shot, by the way, of New York City right now. Dow up about 40 points, NASDAQ up about 8 points. You're looking at the S&P 500 just about 2 points. As we all await the bill that's passed or should pass through the House, we'll see when that all happens. We also got the big jobs number coming up in just a moment that can move all of this around. But in the meantime, I want to get over to Dom Chu, who's got a look at this morning's pre-market numbers. What's on deck here?
All right, so Andrew, Melissa, we're going to kick things off with shares of Tesla up slightly, trying to extend its rebound after climbing 5% in yesterday's session. The EV giant reporting delivery numbers that were roughly in line with expectations. Before that, shares had been on a 6-day losing streak where they slid about 13%. So Tesla up fractionally right now. We'll keep an eye on those moves. Next up, you got shares of Datadog higher by roughly 9% now, after S&P Global said the software provider will replace Juniper Networks in the benchmark S&P 500 index following HPE's deal to buy Juniper. That change goes into effect at the start of trading on July 9th. Wedbush, by the way, is raising their target price on this morning on this shares of Datadog to $170 from $140. That's roughly 26% upside from yesterday's closing price. Analysts say that the inclusion in the S&P validates the company's growth story. They believe it will continue to capitalize on its observability initiatives and whatnot. So now for more on that and other top calls of the day, just head over to cnbc.com/pro. Subscribers get all the access to the detail behind those big upgrades and downgrades. And we'll finish with shares of Oracle higher by just about maybe 0.5% or so at this point, following a 5% climb yesterday. That came on a report from Bloomberg that OpenAI agreed to pay for a large amount of computing power from Oracle as part of the government's Stargate AI project. OpenAI will reportedly pay Oracle for roughly 4.5 gigawatts of power. Now, that's enough to power millions of homes and whatnot. So the partnership agreement and whatnot is kind of what's driving some of that news today. I'll send things back over to you.
Okay, Dom Chu, thank you for that. Happy July 4th. If I did not talk to you before then, sir.
Happy birthday, America.
Coming up, jobs in the Fed. What will Jay Powell and company be monitoring inside today's June employment report? We'll talk about that after a break and get into President Trump's latest criticism of Fed Chair Jay Powell. Squawk Box will be right back. Investors are awaiting the June jobs report. It's a key piece of data that could have an impact on the Fed's next move. It comes amid renewed pressure from President Trump on Fed Chair Jay Powell to cut rates. Last night, he said Powell should be fired. Let's bring in former Dallas Fed President Richard Fisher. He is now senior advisor with Jefferies and a CNBC contributor. Also with us, CNBC senior economics reporter Steve Leisman. It is great to see both of you. Richard, it's great to see you again. We just had a conversation about, the time when President Trump called Jay Powell a stupid mule, which was just a few days ago, actually. But here we are now, and I'm wondering, if you think of Powell as having any sort of leverage in this conversation, in that he could give up, step down, obviously, when his term as Fed chair is up, but stay on as a governor.
Well, that'd be a tough decision to make, but he could do that. Again, I want to remind, we talked about this, Melissa, you and I, before. There's sort of a Fed derangement syndrome, and it's not unique to Donald Trump. Again, Lyndon Johnson took Bill Martin, who had been chair from 1951 to 1970. He took him to the ranch and physically beat him up. Like, our boys are dying in Vietnam. You're not accommodating us on monetary policy. And Martin went to his deathbed. He wrote in his memoirs, he went to his deathbed ashamed of himself. No one's going to do that. And then we forget, Ronald Reagan tried to impeach Paul Volcker. So this isn't unique to Donald Trump. The expressions are unique. Jay Powell knows this. I don't think it has any impact on him at all. It wouldn't if it were me. I understand why he's doing it. The president has a constituency that thinks if the Fed funds rate is cut, it's going to lower their credit card costs, their mortgage costs, their car payments, et cetera. It doesn't work that way, because the Fed does not control the latter part of the yield curve. The 10 years determined by supply and demand. So I understand why the president's doing this. It's political. I understand it. It's not unique. And by the way, he's not as brutal as Lyndon Johnson. So we'll just have to see. I don't read a whole lot into it. I don't think it affects policy. I think the jobs numbers will have a bigger impact than anything else on the next meeting in September and so on.
Richard, just one related question on this. At the end of Jay Powell's term, what do you think it will feel like from going from being the chair to being a governor? We were discussing sort of what that, on a personal level, could feel like.
Well, first of all, it's not clear he's going to do that. He could go on another 2 years. I think it really depends on if he feels that whoever is appointed is a Trump lackey and is going to infringe upon the independence of the Fed. He could stand on principle on that and make that person's life very difficult. But remember, that individual, whoever it is going to have to carry the whole table. You got 12 bank presidents, the vote rotates, and you have the other governors. So if it's somebody who they feel is not going to protect the independence of the Fed, then there's no need for him to stay on. He's not a stubborn mule. He's a smart guy. He's done a very good job. I love this. When you say inflation is running at 1.7% in the White House, guess who made that possible? The Federal Reserve. Guess who's kept employment in pretty good health? We'll see today what's happening, but it's been the Federal Reserve. So it's hard to criticize them. Mistakes were made with transitory inflation, no question about that. But since then, they've operated very, very well. We'll just have to see how the other governors and the other bank president, all the bank presidents feel about whoever's appointed, because that person's going to have to lead them. And if they don't have respect for that person, we won't be able to.
Right. Steve, I don't know if you want to weigh in on this issue or if you want to talk about whether or not a number out today could actually make the July meeting live.
So I'm amazed at how calm and collected Richard is and how he's put it all into some sort of historical context that all of this is normal. Richard is not that much older than me. He didn't live through it, but he acts like he lived through it. It was all okay. I think this is all reaching a boiling point here. I think this is much more on tenterhooks in terms of the chair's position here than it appears. You have now the Senate is talking about things like investigations. The head of the FHFA is after Powell. I think the chair is a strong person. I think he can hold on, but it's going to be tough and it's going to be difficult. And I also think that from the research that I presented yesterday, all of this does have an effect. It's been shown over time that presidential pressure, not like a cut or so, but in basis points, it does end up reducing things. So I think that if this report ends up being negative or really, really weak, I think the Fed could cut in July, because I think there's that kind of political pressure on the Fed. I also think that.
Wait a minute, you're saying that he's going to cave? I mean, if the FHFA investigation, if that were really serious and that there was a real concern that Powell could be removed because he made false statements regarding renovations to the Fed building, because that's what it's all about, basically,
Right.
that the bond market
Right.
would react. And in fact, we saw yields move lower. I mean, you would think that you would have
The
the
bond market's
opposite.
already reacting, Melissa. It's interesting. This is what I talked about yesterday. There's actual and perceived independence of the Fed, and the bond market is trading in a sense as if the next Fed chair is already going to lower rates. It's really interesting. There's so many reasons for bond yields to be higher. I think Andrew was talking about that in the last hour. You have a weaker currency. You have a deficit that's about to go up quite a bit. All kinds of reasons for the bond market. You have tariff inflation potentially coming. And what's happened? Yields have come down while the president has been pressuring.
There is a
But you have
difference
to remember,
between.
Melissa,
Okay, go ahead,
First
Richard.
of all, no, I mean, yields are still stuck in the 4% range. Only the 2-year has popped below 4% to 3.995. Come on, we're being a little bit too excited here. But if the numbers, for example, the Warren data that just came out, Warren is when they have to announce in any company that they're going to have significant layoffs and they're going to have a change of location or the employment picture. Those numbers are up. So we'll have to see. But if we're talking about a 4.5% unemployment rate, that's not dramatic. It's still historically low. I'm not calm. And by the way, I appreciate Steve saying that. I'm probably 20 years older than he is. But anyway, thanks for mentioning.
You don't look it.
Close in age, Steve. I really appreciate it. Anyway, this is a tough thing. There's no question about it. I would not want to be Jay right now, Mr. Powell, because I don't like getting the slings and arrows of an angry president. But again, it's not unique, and we don't want to have another Arthur Burns become chairman of the Fed, because then we will have a significant inflation problem. And that's why Paul Volcker had to be brought in to break the back of the system. Rate paying. We don't want another Arthur Burns, and if it's someone who is too accommodative, that's what we're going to get. And the committee's going to worry about it.
We got to leave it there. Steve, nice to see you. Richard, it is always a pleasure. Thank you.
Even early in the morning, Melissa. Good to see you.
Nice to see you both. Happy July 4th, Independence Day coming up. Republican Congressman Ralph Norman is going to join us on the fight currently going on in the House over President Trump's big tax and spending bill. Not much of a fight at this point, except for Hakeem Jeffries, who's still fighting, at least talking about it. We're coming right back after this.
save.
Welcome back to Squawk Box. Our next guest is Republican House member who opposed President Trump's big bill as of late yesterday, but overnight he voted to move forward with the bill. Joining us right now is Congressman Ralph Norman, Republican of South Carolina. You were outspoken on the other side of this bill, sir, and here we are this morning. What has changed?
Well, we had a lot of problems with the Senate changing our bill up, mainly adding to the deficit to the tune of, with interest, right at $1.2 trillion. We were unhappy with a lot of the subsidies that weren't phased out that the Senate put back in. We were unhappy with the Senate allowing illegal aliens to draw a paycheck from Medicaid. It just didn't add up from the bill that we sent over, that we had a hard time, conservatives had a hard time passing, but we did. We got to 218, and we were trying to make this bill that the Senate originally said they were going to leave intact and actually cut more than what the 1.6 that we cut in the House of Representatives. But all in all, the tax cuts is what was really driving the bill and the passage. American businesses could not afford a 26% increase.
What I don't understand is you had a view that was negative about this bill yesterday. Is there something different about the bill today?
Yeah, it is. We met with President Trump, and he did a masterful job of laying out how we could improve it, how he could use as his chief executive office use things to make the bill better.
So there are big distinctions between. I guess what I'm trying to understand is the bill that was sent from the Senate back to you is fundamentally different from yesterday to today, because then the Senate would have to.
We accepted the bill as is. What's different is President Trump is going to use his powers to, like on the subsidies, to make sure that a lot of these subsidies won't remain in effect, from here on out. And he made it clear too that had we put it back in the Senate, it was going to get worse. They're going to, particularly Murkowski, was going to extract a pound of flesh for anything that was sent back. And we took that seriously, and up until late in the night, we were negotiating things that could change with the tax credits, which all were put in by Joe Biden, which needed to be extinguished. And
so which subsidies are set to be extinguished? I'm asking because there's so many sectors out there, Congressman, as you know, who thought things are going to be terrible in terms of subsidies. The phase-outs were not as bad, and the sectors rose again. I'm just wondering what subsidies you believe were promised to you would be phased out, eliminated.
Solar panels, wind and solar needs to be. We would have cut those out day one. We couldn't do that. The Senate put that back in. The $7,500 tax credit for electric vehicles, that's not for government to prop up one industry over another. Particularly, we leave that to the American people to decide what kind of car they want to drive. And the president gave us assurances that changes were going to be made, particularly with getting permits. The language meant a lot to us. Versus you had two different lines that the Senate changed. They wanted to put, when construction began, is when the time frame would extend for like the wind and solar. We wanted date of service, which means they can't take a backhoe out there and dig a ditch and say that's construction. So things like that the president is going to enforce. And
Congressman, let me ask you a different question, which is, for those conservatives who have been concerned about adding to the debt and deficits in our country, there's always been a question about whether this deadline, if you will, is an artificial one. Yes, by the way, the tax cuts expire by the end of the year. That is true, but they don't expire by July 4th. And so the question is, if you have the concerns that you've had, at least up until last night, about that piece of it, and what your constituents, by the way, might think of that, why not hold out and try to push for a better bill? I know that everybody sort of kept saying, well, if we don't do it, it's like a bomb is going to go off, but we're still months away from that.
Yeah, but what changed is the president giving us the fact that the longer we waited, and let's say we had gotten it back to the Senate for changes, even minor changes, they were going to make it worse. And we believe that. And we held out as long as we could. You know, I voted against, in the Rules Committee, Chip Roy and I voted against, with the 2 votes, voted against moving it forward. So we held out as long as we could and made the changes that we knew we could make. And July 4th was not set in stone. You're right about that. I mean, the president wanted that, and which was fine because he knew the quicker we got this done, the better off we would be in getting something across the finish line. So those were the things that mattered, and we accomplished that. And his July 4th was important to him. It was important to Mike Johnson. So there's no reason to wait. Now, let's say if the Senate were up in the air, if the senators that changed this, if they had changed their mind or could, not make it worse, we would have done just what you said. But no, the time was up. It was time to move on it.
Congressman, we're going to run out of time. I have one final question. It sounds to me in some way that you were saying that the president persuaded you by saying that he is going to some degree, override some of the provisions in the bill. Is that right?
No, he's not going to override it. He's going to on the permitting. He's going to drive a hard bargain on the permitting. He's going to have accountability is the best way to describe it. And he assured us he was going to do that. And I think some executive orders you'll see come down the pipe, which will be good.
But also remove subsidies on wind and solar, correct? The ones that are currently in the bill.
No, he didn't. He can't remove them. He's just those that, they had timelines for these, and we couldn't alter that. The Senate actually made it longer. So what he's going to do is use his powers as chief executive to make sure that the companies that apply for solar credits, as an example, he's going to make sure that they're doing what they say, and when they say they've started construction, he's going to make sure they've done that.
Right. Congressman, I want to thank you for joining us. I want to wish you a happy 4th, and we'll see what happens with this bill a little later today. Appreciate it.
My pleasure.
You bet. Coming up, a big call on part of the market that has seen some stock jumps 1,000% in a year. What are we talking about? Quantum computing, that's what. We'll tell you all about it right after this.
The frog is a liar.
It is 8 a.m. on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Ross Orknell and Melissa Lee hanging out with us ahead of the holiday. It's kind of like a half-day holiday, but not in the news business today.
It's still a 3-hour show.
No,
Andrew.
3-hour show, but the markets close
Yeah,
at
at
1 p.m. today. Having said that, a lot of news taking place. We're following two big stories. The fight over that in the House, rather, over President Trump's big tax and spending bill. Shouldn't say there's much of a fight. It sounds like it's a fait accompli this morning. Although you're looking at Hakeem Jeffries right now, speaking live. He's been doing this now for several hours, pulling a bit of a Cory Booker here. We'll see how long he speaks before this whole thing goes to a vote. And then we've got the June jobs number, set to get the government's latest employment report in just about half an hour. Economists expecting an addition of 110,000 jobs. But yesterday, as we heard right here live on this broadcast, ADP reported a loss of 33,000 private sector jobs in June.
Now to part of the market that has seen some impressive moves. Quantum stocks jumping yesterday after Cantor Fitzgerald initiated coverage on the sector. Quantum computing may be in its early stages still, but valuations are already running high. Joining us now is an analyst who believes the long-term impact could be massive. Ray Wang, Constellation Research founder and chairman. Ray, great to have you with us. And of course, we all know that Alphabet has been in on this and has made some tremendous strides. These companies, though, they are fledgling. If you take a look at, for instance, D-Wave, first quarter revenue is $15 million. The company's market capitalization is $5 billion. So where are we in terms of valuations and the actual cycle for quantum?
We're getting in early. Basically, it's spring training season in baseball. We haven't gotten to the first inning. They haven't sung the Star Spangled Banner, but there's a lot of excitement. And when you take companies like D-Wave and IonQ and Quantum Computing and Rigetti, well, they're all doing something different, and they're all advancing the ability to do amazing things in computing. Imagine if you could actually do drug discovery in years instead of decades. If you could do the ability to get quantum security to break codes in seconds, and might even get the weather forecast right. They're all going down different ways of delivery. And so you've got D-Wave that's worth a lot in terms of being able to deliver premiums in terms of quantum computers that are really accurate and stable. You got IonQ that's actually pushing the limits of where quantum computing can go. You got in terms of quantum as a service, and you got Rigetti that's basically figuring out how to actually deliver custom computing out there. And of course, quantum computing being able to deliver communications at quantum levels. And that's really what people are getting excited about, because they're looking for the next thing after AI.
But do you think that people are getting too excited at this point? I mean, I think that's the question when you take a look at some of these stocks. I mean, they're up 1,200% in the past 12 months. They have very small amounts of revenues right now, and the market is affording them a very high valuation. Is that just? Do we pay those sorts of valuations here during spring training, or do we wait till the third inning or the fourth inning when things are more clear, when there is a more quantifiable total addressable market?
Melissa, it's a great question. And you really have to ask yourself, do you want it to be more stable? You've got a lot more customers in place. But you take a company like D-Wave, they've got 100 customers, 250 patents, 200 employees, and they've just closed another $400 million in equity. So basically, the investors are saying it's jump in early or miss the wave in quantum like you missed the wave in AI. And I think that's the FOMO that's in the marketplace.
So the AI story is helping to fuel this in that we saw what it was like if you missed out on investing in NVIDIA early, and you don't want to miss it this time around.
Well, you're like, hey, there's a game chip designer. They're doing graphical chips. What can we do with this? There's kind of a dead stock back in the day, and then suddenly, boom, GPUs and generative AI took them to the next level. And so the same thing's happening with quantum, and the advancements are moving very quickly. So what might have been a 20-year cycle has been compressed to a 10-year cycle, and we're now down to a 7-year cycle where we're going to see some gains, and investors are starting to realize something big is happening here, and they don't want to miss out.
Ray, we got to leave it there. Great stuff. Thank you, Ray Wang.
We take a quick check on the futures right now as this big, beautiful bill looks like it's going to get passed once Hakeem Jeffries frankly stops talking. We'll see. Dow Jones up about 64 points, NASDAQ up about 22, S&P 500 up about 6. But as we keep saying, all this could move around literally in about 25 minutes from now when we get the big jobs number. We'll see if it's big or not. The 10-year Treasury, by the way, at 4.2. The 2-year Treasury sitting at just 3.7. I want to get back to Dom Chu, who's been taking a look at a number of stocks that are on the move this morning. Dom.
Absolutely right, Andrew and Melissa. We're going to start off with a check on shares of some of the semiconductor software developers. Names like Cadence Design, also Synopsys, both higher by just about maybe 5 to 6% or so after the U.S. lifted export restrictions on chip design software and manufacturers for Chinese markets. The companies said that they are working to resume sales in that region and restore access to existing customers. It comes amid some of those cooling-ish tensions between the U.S. and China as they work towards a trade agreement. So we'll see whether or not those software, Synopsys, Cadence Design semiconductor names will do some more movement here in the coming days and weeks. Let's check on some of the biggest healthcare providers in terms of insurers and whatnot rebounding slightly after huge moves to the downside just yesterday. Centene, remember, plunged 40% after it pulled its 2025 forecast due to an unexpected revenue slump from commercial plans under Obamacare or healthcare exchange plans. That helped drag down all the names that you see here. Molina fell by about 20%. Elevance down by 11%. Those moves coming as Congress gets set to pass the biggest cuts to Medicaid since its inception back in 1965. So we're seeing a bit of a rebound there, fractionally to about 2% for Elevance shares. And we'll finish with two small cap defense tech names. Kratos Defense higher and AeroVironment slightly lower on price target moves from RBC Capital. The bank's going to 275 from $200 for AeroVironment and upping to $50 from 38 for Kratos. Now, RBC expects both stocks to outperform amid continued growth in defense spending, so keep an eye on some of those names. Now, for more on that and other top calls of the day, cnbc.com/pros where you want to go. Subscribers get all the access to the context around some of those big upgrades and downgrades, Andrew. I'll send things back over to you, and I will now wish you and Melissa a very happy 4th of July.
That got you. Thank you.
You got it, guys.
Tesla stocks snapped a 6-day losing streak yesterday. Market cap climbed back above $1 trillion. Second quarter deliveries fell year on year, and they missed estimates, but not by as much as analysts had feared. Joining us now, George Gianarikas, Canaccord Genuity analyst in Phil LeBeau, is also with us. Great to have you guys. George, I want to start off with you because, this was better than feared, but at the same time, it doesn't lift the burden that Tesla has to fill in terms of hitting delivery numbers in order to make the annual number by the end of the year. They've got a big weight to lift at this point, and at the same time, they've got the EV tax credit going away. How do you foresee Tesla hitting those numbers if you do?
It'll be a hard slog for them to hit those numbers, particularly as you mentioned with the EV tax credit going away. The thing that we're thinking about for the back half of the year is a couple of, or maybe a few new models that they've promised. It was recently disclosed in their impact report that they expect new, more affordable models to come by the end of the year, so that should help. But your point is valid. I mean, we have to see EVs get back to growth, hopefully by the end of the year, maybe in 2026, but it's a key part, obviously, of the story. But investors seem to be relying upon excitement around robotaxi and Optimus to drive the stock here.
Yeah, and it's interesting, Phil, because robotaxi, for as many fans and influencers were in those taxis riding around posting about it, there are also some misses when it came to some of those rides. Elon Musk has also promised a lower cost vehicle, which may also spur some excitement later on this year. How do you see that side of the equation playing out, Phil?
Well, let's start first off with robotaxi. This is how Tesla operates now. Tesla is very much about, we're going to be out on social media, we're going to have the influencers out there, we're going to have our supporters, including those analysts who are very bullish about us, talk about how great robotaxi and our autonomous vehicle technology is. The reality is they have launched a very small launch in Austin. Now here comes the challenge. You have got to show, A, that you can not only do it consistently and safely. It doesn't matter how many times you post on social media, but if you can do that, and then if you can expand on a fairly regular basis, then you will start to see people really get behind the robotaxi and AV story at Tesla, more than the core believers. The core believers are always going to be there. They're not going to leave. They would have to be shown something dramatically different in order to give up on Tesla. And then with regard to the more affordable model, Melissa, look, I think everybody understands that's what's holding back EV sales and will continue to hold back EV sales in the U.S. After the tax credit goes away, the $7,500 tax credit goes away. You need to bring down the price of EVs. You get it down consistently in that $35,000 to $45,000 range, and not just a couple of models, then I think you will start to see EVs take off a bit.
Right, and that's a good point in terms of offsetting the loss of the tax credit with a lower price model. But George, when it comes to ultimate valuation Tesla, blue sky sort of valuations, the most bullish analysts rely on robotaxi, autonomous vehicles, Optimus, all these things that are not the auto business, right, for the most bullish forecast. So how important for you is the working of the auto business when it's really these other areas that are not quantifiable right now, not commercialized right now for that matter, in order to drive the valuation higher?
I'm a pretty meat and potatoes kind of analyst, so I just try to look at earnings. And right now, before they report earnings, we're about $9 in non-GAAP EPS in 2027. We'll see how those have to be adjusted when they report, but you should put a healthy multiple, in our opinion, on that number. It's going to take a lot to get there. They have to return to growth in EVs. They have to get margins better. But if you can get to $9 plus or minus in 2027, and then have these dreams of more Optimus by 2030, additional robo-taxi miles by 2030, you can sort of justify the stock here and get to even higher levels if those businesses start to take off. So we're all about earnings. We don't really do some of the parts valuations, but if you can get to that kind of earnings number and something even better than that in 2030, then I think the stock works.
Yeah, I definitely like meat and potatoes, so it works for me. George and Phil, thank you.
Okay. Coming up, the latest on President Trump's mega bill set for a vote as soon as Minority Leader Hakeem Jeffries yields the floor. He's been speaking now for several hours this morning. Democratic Congressman Ro Khanna is going to join us next from the Capitol. And the jobs report is on the way. We're just a little over 15 minutes from now, 17 minutes exactly. We're going to bring you the numbers and reaction. All this could move around this morning. Let's see where it goes. We'll come right back. big beautiful flag
It is a
as the
beautiful
big
shot.
beautiful bill gets close to being passed. But it is a beautiful shot ahead of July 4th. We are waiting on a House vote now on President Trump's tax and spending bill. Hakeem Jeffries continued to speak, as we keep saying, pulling a bit of a Cory Booker the last couple of hours. We'll see when that finishes. Congressman Ro Khanna of California has been listening to Hakeem Jeffries, the minority leader, but just popped out for Squawk Box. Good morning to you, sir.
Good morning. It's been a long night.
It's been a long night. You're on the losing end of this situation. What do you think the implication is here?
There are two major problems I have with the bill. One that Larry Summers and Bob Rubin pointed out. This bill is going to add $4 trillion to the national debt, and it's going to take deficits to 8% of GDP, almost unprecedented in peacetime when there's no external shock like COVID or the Great Recession. And the second is the distribution. I mean, even Bush's tax cuts and Trump's tax cuts helped everyone. They disproportionately helped the rich, but they gave a break to everyone. These tax breaks actually make poorer working class Americans poorer while giving the rich tax breaks. They take away Medicaid, they take away food assistance, and that's pretty unprecedented in modern history.
We talked to a congressman on the Republican side of things who actually had a negative view of this bill last night and a positive view of it this morning. And one of the things he said was that he got assurances effectively from President Trump that certain parts of the bill may be slow walked or other things might happen as it relates to a whole number of things. Have you heard that in terms of those holdouts who've come along, why they've come across?
Well, one, they don't want a $20 million super PAC coming after them in a primary. I mean, look at what happened to Thomas Massie when he spoke out against the Iran strikes and the War Powers Resolution. So Donald Trump has a lot of power in the Republican Party. But on the substantive thing, I've been told that they've been promised future reconciliations that are going to make more cuts. The question is, though, how are they going to pay for them? The reality is you have to raise taxes on the wealthy. You can't be cutting taxes on the wealthy if you want to do anything to lower the deficits. It's not just me. That's what Rubin and Summers say. That's what economists who look at the math say. And so they're being promised future reconciliation packages to cut the deficit, but it's unclear where those cuts are going to come from if they're not willing to increase taxes on the wealthy.
Congressman, I want to weigh in on this. We've been watching the bond market, which you would think would not like a bill like this. Just the conventional wisdom would be that. The market is not moving. It is not. The bond market is not acting in a way that's suggestive that they have a problem with this bill. Now, on the other side of it, we talked to Steve Leisman recently. One of the interesting things that may be part of the calculus is there's an expectation even already that a year from now, Jay Powell will not be in this job, and maybe you'll have a Fed chair that's going to start lowering interest rates. And if that's the case, maybe that's offsetting whatever anxiety there would be. But then you probably have even more anxiety about the dollar, frankly. So how do you reconcile all of that?
Well, it's surprising to me. I mean, obviously the bond market's moved a month or so ago, and maybe they've already factored in that this bill was going to pass. I think that the longer term issue is, let's see what the jobs report say today, but you've got tariff policy that in my view is slowing the economy, and we're going to see perhaps in this jobs report or in Q3 combined with now massive deficit spending that's going to put pressure on our interest rates. And that's the concern, that you have a slowing economy and at the same time higher interest rates. But you know, obviously, I don't have a crystal ball in terms of what the bond market is going to do. I just think that we don't have smart economic policy right now.
Can you do you acknowledge that this bill, though, could improve the economy or help businesses, which will then improve the economy overall? I mean, permanent expensing, that's a very, that's very attractive, and could be very good for businesses to spur investment in equipment as well as facilities. Making the tax cuts permanent, that is a very, that's key to stabilizing the outlook of the economy. I mean, there are offsets here, Congressman, to this, aren't there, in terms of, your concerns about the deficit? It could ignite some growth here.
Well, are there aspects of the bill in isolation that I could support? Things like the no tax on tips, things like the making child tax credit permanent, no tax on overtime, absolutely. But overall, the bill is skewed to people who are extraordinarily wealthy. About 60% of the benefits are going to go to people over $220,000. This is not the kind of bill you would pass if you wanted to have more consumer spending. You would do what Josh Hawley was saying, double the child tax credit. You would skew most of the tax credits and tax breaks to the working and middle class. And we saw with the previous Trump tax bill that it didn't lead to higher investment, that it was basically distributionally skewed towards the wealthy, and it didn't lead to more manufacturing or domestic investment. And there's no reason to think that this is going to lead to that kind of productive investment now.
Congressman Ro Khanna, thank you for joining us this morning. It's good to see you. We wish you a very happy 4th, and we'll see when this bill gets passed, what happens next. Thank you.
All right, of course, we have another big story this hour, and that would be the jobs report. We're counting down to 8:30 a.m. Eastern Time. That's next.
"249 years ago, the Declaration of Independence was signed in Philadelphia. While the rest of the country celebrates, City of Brotherly Love is on day 3 now of a garage strike.
Garbage.
Did I call it garage?
Yeah,
Garbage strike.
different.
Yes, well, a garage strike would be a different thing. A garbage strike, I apologize, is going to be, if you can believe this, 90 degrees for the next 5 days in Philly. And that, of course, not going to help. The water department staff, some rec workers, 911 dispatchers, also off the job. So
It's terrible.
Not a great time.
I feel bad for all the tourists going to Philadelphia to celebrate the nation's birthday.
The garbage.
Yeah.
They should just stick it in the garage.
Since there's no garage strike.
Yeah, coming up. The number of the morning. Don't go anywhere. We got June jobs. The big report. 2 minutes away. We're coming right back.
We're happy with it.
We are just seconds away from the June jobs report, and we're seeing futures across the board higher. The S&P looking to add 4 at the open. The Dow looking to be up by 50. The Nasdaq looking to add 9. Taking a look at Treasury markets, we are seeing yields lower this morning, with the 10-year clocking in at 4.265%, the 2-year at 3.77%. It is worth noting that at the start of May, we actually started with the 10-year yield at 4.6%. So yields have been coming down, prices have been going higher, even with the big, beautiful bill up for vote as we speak, or actually Hakeem Jeffries is speaking right now. It should be up for vote shortly in the House. So we're looking at this very closely. There's some thinking, too, that a weak jobs report could make the July meeting for the Fed live, meaning they could consider cutting rates at that meeting. So we are watching this number very closely. We're just about 20 seconds away. Rick Santelli is at the CME in Chicago. I don't know what you think about July possibly being a live meeting based on these numbers, but sub 50 in terms of additions seems to be the number that could make it live in the markets.
Anything's possible. We'll know shortly. Obviously, it's the big June jobs report. I wouldn't look for this to make an easy more likely. 147,000 jobs. Definitely better than expected, no matter what your range was, whether it was closer to 100 or 115,000, it's a pretty good number. And guess what? If we look at the 2-month revision, it's positive. It's up 16,000. How does 147 stack up? Well, it's pretty odd because it's exactly where we were in April, unless they revise that. To find a higher number than that, well, you're going back to last year. So this is tied for the, second best, tied for the first best number of job creation of the year. Now, let's look at the numbers for unemployment rate. That number is coming in at, well, it's coming in at, is it to underemployment? There it is, 4.1%. Sorry, folks, we do this on the fly. 4.1%, and obviously 4.1 equals where we were in February to find a lower unemployment rate the beginning of the year when it was at 4%. Now, if we look at average hourly earnings, up 0.2, we're looking for up 0.3, and the rearview mirror is up 0.4. Up 0.2 equals where we were in April. To find a lower number, you really have to go back in the Wayback Machine. You're going all the way back to August of 23 when it was up 1/10. So earnings are something to pay attention to. And you see the same dynamic when you look at year-over-year average hourly earnings. 3.9 the rearview mirror, 3.8 expected. Boy, 3.7. How does that stack up? That would be the lowest yearly rate going back to July of just last year when it was 3.6. Now, if we look at the average weekly hours worked, 34.2. That equals where we were in February. We started out the year at 34.1. The underemployment rate. So U3 is the actual unemployment rate that we pointed out. The U6 is the underemployment rate. We like to pay attention to that. Obviously, it's been coming down rather dramatically. That now stands at 7.7%. That follows 7.8%. And that would be the number that we're very close to expectation. Finally, labor force participation, always important. We want to bring back people in the workforce, and this time we did not. 62.3. We lost a 10. 62.3. And what's very fascinating about this is these numbers have been pretty steady. 62.3 equals DECE of 22. 62.1, you're in NOVA of 22. Listen, it doesn't end there. This is Thursday. Initial jobless claims coming out at 233,000. That is a drop of 4,000. It was slightly revised, 237,000. Still keeps that pretty darn good. Just like JOLTS, not a bad number for the labor market. ADP seems to be an outlier at this point. And finally, continuing claims coming at 1,964,000. That means it's what, 6 consecutive readings over 1.9, basically comping to 2021. And the trade balance for May, which is obviously a deficit, at minus 71.5 billion. In the rearview mirror, 60.3 billion. Boy, has that come down with all the trade issues. Just think, March was 138 billion, by far the biggest deficit since record keeping in 92. Now, after all that, what happened? Well, all you needed to see was that 147,000 in positive 2-month revision. Yield shot up like a bit of a rocket ship. 435 in a 10, we settled at 428. In a 2-year, 380, that's up 11 on the day, and both of those metrics were down 2 basis points before the number. Pre-opening Dow futures more than doubled from up a little less than 50 to now up 115. It should be no surprise that these are good numbers. And Melissa Lee, you were asking, would I think that this is going to make a big difference, put July hot? I think what this does is make everyone question the dynamics of what issues are going on in the economy that would need an ease. I understand the president's view. I understand Jay Powell's view. But in the end, it certainly seems as though it's just about right now, considering what's going on with the risk on, risk off in the equity trade. Back to you.
All right. Steve, let's bring you in here. What's your outlook in terms of the impact on July, September, which was pretty much a foregone conclusion?
I think this is a very mixed report, Melissa. I have to point out, I don't even know if President Trump is going to like this report.
Why?
73,000 of the job gains were government. Now, it was minus 8 on the federal side, plus 40 on the state side, and I think it was plus 20 or 30 on the local side. So what you have is you have the weakest private sector growth since October of 2024. And it was bizarre to go down the table and you look at it, you see a lot of negatives, a lot of positives. It goes back and forth. I'm trying to find the diffusion index, which tells us what a I don't see it here right away. It tells us the percentage of industries that were raising and lowering. You did have good job growth in the service sector, which is the opposite of what ADP thought. But private education, again, up 51, healthcare up 58, leisure and hospitality up 20. These were the same places we had job growth previously, so not much change there. But you do have to take account. What I think happened here is this anomalous hiring in the state and local government is what makes this so much higher than what the street was estimating. I think there was a feeling on the street that government would fall and the private sector would be weaker. So you would have 70 or 80 minus the federal government or minus government. Instead, it was 70 or 80 in the private sector plus. So it's a mixed report. It's good the unemployment rate fell. That's a good number right there. It's good that we're positive on job growth. I'm just not sure what's happening at the state and local level that's driven all of this employment. I would think it would be a very mixed feeling, and then the Fed would say, okay, I need another month in this, especially because, as Rick pointed out, the claims number is healthy again. So I wouldn't be too concerned about that part of it.
Are you nitpicking, Steve? Are you? Because I mean, it was a good headline number. The rate was better than expected, and we had positive revisions and we've had negative revisions. I'm just wondering, if we're losing the forest from the trees here by focusing on where those ads were.
Focusing. Well, the rest of the panel will weigh in. I would say that generally focusing on the private sector is the best way to gauge the health of the economy here. I don't know. It might be that state and local is picking up jobs that were laid off from the federal government. I don't know what's happening there. But if half of your growth is from the federal government, you can't really stay back and say, oh, the job market is very strong right now, especially because you believe that government hiring will have a lot of pressure against it. So I don't think 70,000 is nitpicking.
Okay, Steve, just pretend for a second that you could play the conversation. If Jay Powell were to call up President Trump right this second, if President Trump were to call up Jay Powell, what would they say to each other?
That we could say on TV.
I think Jay would say, "How's your golf game, Mr. President?" Or something. I don't know. I think he'd say, "Look, this is a report that raises some questions about whether or not how soft the market is. Maybe one of our panelists has an explanation of what's happening in the state and local government, but it's the lowest private sector job growth since October of 2024. I still think the job market is okay here. It's not falling off a cliff. I think unemployment rate's okay." But I just want to put that asterisk on it, which is 70,000 of the jobs were from the government side. So when you look at the health of the economy and hiring, you say, I don't know. There's some questions out there, and I'd just be a little circumspect. I wouldn't cut rates right away, but I'd have my finger near the trigger.
All right, Steve, stay with us. Let's bring in the rest of our jobs panel, the Brookings Institution's Wendy Edelberg, the Manhattan Institute's Allison Schrager, and our own Mike Santoli. Great to have you all with us. Wendy, let's start off with you. What's your take on the report? What's your take on that asterisk that Steve brings up in terms of the growth from the federal government in terms of job ads?
Yeah, Steve makes a great point to focus on the private sector. The main challenge here, and I think the main challenge for Jay Powell, is what's a good number? And right now, it is completely perplexing to be able to answer that question. And the reason is immigration. It looks like the recent surges in immigration in 2023, 2024 are actually still putting upward pressure on labor supply all these months later, even after it slowed in the second half of 24, and then immigration clearly slowed in the first months of the Trump administration. And yet we have a lot of information that shows us that immigrants who came since, let's say, 2022 are just now working to enter the labor force. And to the degree that they're doing that at speed, it could be that a good number in the first half of this year should have been more like 200,000, which is to say the numbers we're seeing now may actually suggest some softness. This is all about what's the break even, and we are just in the grip of when those break even employment report numbers are gonna massively shift. It could be that we shift from a world where Actually, a good payroll employment number in a given month was 200,000 in the first month of this year. That could be as low as 10 to 40,000 in the second half of this year. We are just in the grip of this change because of the wild swings in immigration.
Allison, do you also believe that we are on the precipice of a major change here in the labor market?
Could be, but I think just still, I feel like we keep looking for the shoe to drop, but we keep getting good reports. It's not just this employment report. It was also JOLTS. It's also inflation. And for right now, the economy looks pretty strong. It's still keeping on, despite all this uncertainty, despite all this tariffs. I guess we can't explain it, but at the very least, I don't see how the Fed could justify cutting rates right now. I mean, not only that, it doesn't even seem the high rates where we are. We're supposed to be still in a high rate environment to finish off inflation. It doesn't seem to be having a contractionary effect on the economy. So it even is sort of suggesting that the neutral rate is much higher than it was pre-pandemic, and it's really hard to justify cutting rates until we actually see evidence of significant weakness. I feel like we keep squinting for third or fourth order derivatives to justify a weakening labor market, and it might be weakening some, but it's hard to call this economy truly unhealthy.
What would be the number that would be truly weak to you? I mean, what's a cutoff point? Because you're right, people are squinting, they're looking, they've been thinking this is going to happen for so long, and they're trying to find any sign of it.
Well, I mean, as Wendy points out, we might end up with much lower job creation rates, but that might also reflect lower immigration. But that would also mean we still have relatively low unemployment. So if that's the Fed's goal, is keeping unemployment low, even if we do end up with lower employment reports, that doesn't necessarily justify cutting rates. So, I mean, I agree with her that as we have the impact of lower immigration, we're going to see lower reports, and we might have to also adjust our bar for what's a low bad report.
Mike, I want to go to you because we saw a quick reaction in terms of futures higher, in terms of bond prices higher, yields higher in the bond market. We also had gold move lower, so definitely sort of a risk on feel to the market this morning based on the jobs report. What's your interpretation? Because it had been thought that a weaker jobs report could make a Fed cut more likely and therefore be better for the stock market. And here we are.
Yeah, look, I think obviously the markets are unclenching a little bit because we were braced for the possibility of a more pronounced downside surprise. I think this is absolutely, on most measures, a good enough number in equity market terms. It's another month when you didn't have any kind of a reckoning. You didn't have to change the general narrative of, soft-ish landing. It's enough job growth to bring the unemployment rate down and essentially keep the consumer in the game. The basically default mode of the U.S. economy is to add some jobs every month in the absence of some kind of a shock. I guess maybe the sort of tariff scare and the confidence shock we got a few months ago wasn't enough at this point to do it. Within the stock market, I found it interesting. It's been the cyclical areas of the market that have held up pretty well. Consumer, leveraged companies. So clearly the stock market is sort of priced for good things or continued good things. And I think if a rate cut comes in September into a decent economy, that's best case scenario. Best case scenario is not we weaken quickly in the economy and the Fed has to come to the rescue. I've never thought bad news is usually good news. Only in very isolated circumstances does the stock market like that.
Yeah, Steve, I want to go back to you. We're showing right now a graphic of the Fed's rate cut odds as priced into the futures market. What are you?
Yeah.
I don't know if this is live or if it's changed at all since the release of the number.
So, a Fed chairman a while ago, whose name I'm not going to mention, told me that you can boil everything down, and the thing you want to look at to know how the job market is doing is look at the unemployment rate. In that dropped, yes. I would say it takes off the table the possibility of a July rate cut, because there's, as all the intelligent people on this panel have told you, there's an awful lot of stuff going on in the 150 million strong American labor force. There's immigration, there's deportation, there's college graduates, and there's all kinds of stuff going on. There's even AI going on, which could be having a very subtle impact on the college grads, by the way. But how do you sort of walk away with one number that rules them all? It might be the unemployment rate. It came down. I think this gives the Fed covered, which it really wants. It wants another month to see what's going on and a little more time to get a feel for what's happening in the economy. I like Allison's overall comment that the the economy remains relatively strong, and it's very hard to say, all right, where's the part of the U.S. economy that's screaming out right now for a rate cut? I'm going to get some hate mail right now from the mortgage brokers and people trying to buy a home. It's probably the one area, but of course you have this problem. If the Fed were to cut and the market didn't think it was needed, would rates really follow the Fed?
Rick Santelli, he's smiling at Steve. So let's mark this down.
Yeah, because I think Steve was looking at me when I was off camera going wild. You know what? 4.1 is the only number here that you need. He's exactly right. There is no way the Fed's going to be cutting interest rates with a 4.1% unemployment rate. And we could nitpick this jobs report all day long. I'm sure there's meteors flying around there that do have a chance to hit the earth. I'm sure that there's a possibility that climate change, everybody that's worried about it, could actually be right, and something's going to happen in 3 or 4 or 5 years, and the world's going to end. There's always something out there that's weird, and we could always talk about the half-empty interpretation. Here's the way I look at it. The job creation was pretty darn good. There was many months last year when job growth was under 100,000, and you could break it up into government, you can break it up into private. I find it so fascinating that we now break down the numbers in ways I never knew we broke them down before. But to be fair, Steve's always liked to look between private and government, and I do understand that dynamic. But in the end, all that's important here is that this doesn't hurt the market, this doesn't make any meetings any more hot, and in the end, the service sector is the biggest part of the economy, and I'd like to see the job creation focus there.
We're going to leave it there. Wendy Edelberg, Allison Traeger, Mike Santelli, Rick Santelli, Steve Leisman, thank you all. Happy 4th.
Okay, when we return, we're going to get the Whisperer. The Whisperer is going to be with us. Former Fed Vice Chair Roger Ferguson. He's been right just about everything this Fed has been doing for so long now. He's going to join us on the jobs report and what it could mean for the Fed. And we're still watching the House floor in Washington. Minority Leader Keith Jeffries, you're going to be seeing a live shot of this right now, continuing to hold court. They're blasting President Trump's tax and spending bill ahead of that expected vote. He's been at it now since, 5 a.m. this morning?
5:30-ish.
5:30, and he continues Cory Booker style. We're going to watch that and see where this all heads in just a moment when Squawk returns.
theaters now.
Welcome back to Squawk Box. June employment report showing a gain of 147,000 jobs last month. The unemployment rate ticking lower to 4.1%. Immediately, we saw a knee-jerk reaction higher. We are holding on to gains here. S&P 500 looking to add 9 at the open. Dow looking to be up by 50. NASDAQ looking to add 40 at the open. Treasury market also showed a very distinct move higher in terms of the yields. 10-year yield going up to 4.346%. Prior to the number, we were at approximately 4.26. The 2-year Treasury yield at 3.882%. And the odds also changed.
So let's talk about those odds with a man who knows a lot about them. The odds of a Fed rate cut by September coming down after the better than expected jobs report. Joining us right now is Roger Ferguson, former Fed Vice Chair, as well as a CNBC contributor. Good morning to you. Before we get into just your reaction to the jobs number, do you put this in a good category? We had Steve Leisman who found a couple of holes in it. What's your thought?
Well, look, overall, a very good category. The unemployment rate coming down, always very helpful. You know, the job creation number after the ADP surprise yesterday, very welcomed. I'm not sure I agree with Steve on the parsing. I'm not opposed to it, but I think Rick Santelli said something very important, which is this is an economy that's driven by the service sector. That still seems healthy. So overall, this is a check plus. This is a good labor market report.
Okay, so now maybe I'll ask you the question I asked Steve. If the President, Trump, were to call up Jay Powell right now, or Jay Powell were to call up President Trump, and they were to talk about the numbers we just saw across the tape, the conversation would go how?
Good question. Let's assume a world of great rationality. I think Chair Powell would say, Mr. President, this is a good labor report. I think he'd also say something broader, which is the President himself would be better off if the Fed were widely perceived to be independent. I think the President's calling for lower rates in the face of this kind of strong economy or good economy is probably unwise. Steve Leisman said something I think Chair Powell would bring to the President's attention, which is if the Fed were to cut in the face of these kinds of numbers, the market might not accept it as a sign that they too should be lowering rates. The long end of the curve may actually show higher rates as people worry about inflation picking up.
Roger, can I just ask you though about that, which is, and it's actually contextual to even these jobs numbers, this bill today. There had been an argument. The conventional wisdom would be if you're going to add a lot more debt to our balance sheet in the United States and the dollar and everything else, you would think that the bond market would be unhappy about that. You would think. And yet, it has not been remarkably unhappy about that. Steve Leisman has made the point, potentially, that there's already a view in the marketplace, afraid about next month or the month after, that a year from now, there will be a different person in that Jay Powell role, and that they'll be lowering interest rates. Do you think that is what accounts for what's happening here?
No, I don't. I think what's happening here is there are many cross currents that are driving the bond market. One is the ones you just talked about, which is, more debt. One would think that would be raising interest rates. Remember, there's also some talk among some economists, and even I saw in a CEO survey, of a much slower economy and possibility of having to cut not for good reasons but for bad reasons. So I think there's some who have seen that as a possibility. So there are many cross currents here, but I do not think that a Fed that is perceived to be beholden to the administration, any administration, or a Fed that's perceived to be ready to cut rates at a moment's notice is necessarily going to be a good thing. And I don't understand why that analysis is even in the marketplace.
Are you surprised the bond market is not speaking? Are you surprised the bond market is not speaking more vocally though when you hear the president go to take to Truth Social and say that Jay Powell should resign as he did overnight?
Yes, to be fair, I am. I hear among individuals obviously a concern about that. But as I said, there are lots of cross currents that drive this. And some of it may well be a fear that the economy, as some of your panelists are talking about, is actually a little weaker than people perceive. and that may be also weighing a little bit on interest rates at the longer end. So I agree with you. It's a bit of a mystery. I would have expected more of a bond market revolt.
Roger, we have to leave it here for now. I want to wish you a very happy July 4th weekend and look forward to talking to you very, very soon.
Same to you. Thank you.
Coming up, a vote on President Trump's broad tax cut and spending bill is expected as soon as Minority Leader Hakeem Jeffries yields the floor. He's reading letters about how the bill will hurt Americans sent from citizens in districts represented by Republicans who voted to advance the bill. We'll continue to bring you live updates throughout the morning. Scott Fox, be right back.
I need insurance.
Welcome back to Squawk. The U.S. markets are closed for the 4th of July tomorrow, but on Monday we got a big show. Lots that have happened probably over the weekend, but then there's this. Squawk Box has a huge interview coming up with New York Mayor Eric Adams. He's going to join us live on the broadcast, and we're going to get into all of it, so you're going to want to tune in for that. Meantime, a final check on the markets. 53 points higher on the Dow. NASDAQ up about 43 points. The S&P 500 up about 8 points. We will see what happens with the big, beautiful bill today. And we want to wish you, Melissa, a thank you for waking up early with us.
My pleasure.
And you a happy Independence Day, everybody. Have a great weekend. Make sure you join us on Monday. Squawk on the Street starts now.
Good Thursday morning. Welcome to Squawk on the Street. I'm David Faber. He is still Jim Cramer. And we are live from Postland at the New York Stock Exchange. Carl has the morning off. Let's give you a look at stocks, of course. We're closing early today, 1 p.m. close. That's ahead, of course, of the 4th of July holiday weekend. Bond markets will close an hour after that. And there you see, we are headed for a slightly higher open, of course, coming off of those jobs numbers. And that's where our roadmap begins this morning. Futures are getting a lift on better than expected June jobs. Non-farm payrolls up 147,000. And the unemployment rate falling to 4.1%. Plus, we are waiting for that final vote on President Trump's so-called big, beautiful bill expected to pass. That's right, pass sometime today. And we also have cooling trade tensions. The U.S. is lifting chips software curves.
That's a big deal.
Yeah, design software specifically. Talking Synopsys, Cadence Design. We'll get into some of the names that are getting a boost in the early going year as a result of that. Let's start though with the market reaction to this morning's jobs report and your reaction to it.
Well, look, I'm looking at the Truth Social last night. Too late, should resign immediately. That's a reference to Jay Powell.
You're talking about President Trump's most recent posts on social media,
and
where he just continues his relentless assault on the Fed chairman, urging him to lower rates.
True. But when you saw this, you might have think, ooh, the president has insight about the number. And it turns out that he didn't. And this was a strong number. Now, people will turn to the fact that there was a lot of it was government hiring. The point is that it was a strong number. And I'm never one of those people who just says, well, look, you know, I'm going to asterisk that. Strong number is a strong number. I don't mean to be like a win's a win, but you have to recognize that this is something that was surprising, given the fact that the president seemed to be indicating that it would be a slowdown. And it calls into question, where are the layoffs other than Microsoft? Where are the AI layoffs? That's a very big issue.
Yeah,
So
I want to talk about that a bit more because, as you know, I continue to be focused on that, a story in the
Well,
journal
you should.
today. But specific to the market reaction to today's number, 147,000, as we said, and yes, I think 73,000 additions as a result of state and local governments. The federal government continues to lose employees, but overall, this is a good number, a better than expected number, an unemployment rate of 4.1%, and generally some of the other key-ish metrics that we follow, you know, not of concern, right? So, I mean, Andrew kept asking guests, he asked Roger Ferguson, so what is the conversation between, you know, Powell and Trump like? I don't know what that looks like, but it doesn't look like we get a July rate cut. Not that that was on the table. The question, I guess, is September, although I know your admonition is coming about not talking about the Fed at all, because that's what you've been saying
No, I just
lately.
think that there are so many opportunities here that you can just say, what you say is, okay, that's another number where it's not that important what the Fed does. All I'm saying is that you get, if it had been a very weak number, my discourse would change. But this is a number which says, okay, on to the next.
Right.
And on to the next, again, is Synopsys, is Cadence. What does it mean for NVIDIA? Is an upgrade on Meta, is the potential that we're going to see this accelerated depreciation, which I think people are completely missing, which is amazingly important.
As part of the big, beautiful bill.
Yes, I mean,
accelerated
if you took
depreciation.
accounting, or even if you didn't, you just read some stuff, you know that this is big tax deferral. You know that if you have companies reshoring and building, it's really very beneficial. Now, Kramer just said something really positive about Trump. No, this is like what accelerated depreciation
You say
does.
positive things all the time.
Well, that's neither here nor there. What I'm saying, though, is it improves the cash flow. It's one of these things that it reduces taxable income initially, so a company might want to reshore furiously. Now, we know that Vietnam got a break. You know, look, everything's got two sides. I read today that, well, Vietnam could be hurt by this. Well, are you kidding me? I mean, the fact is that we had all these companies that moved, the Williams-Sonomas, the North Faces.
Nike was up a bit, at least to the point.
And Columbia.
Right. I mean, again, announce the trade deal with Vietnam, or at least the prospect of a trade deal. They haven't put the final touches on it, of course.
Right.
You know, Vietnam is a market. It's such a small market for U.S. goods. It's
Not them buying us, no.
Yeah,
but us
hardly
buying them,
anything.
yes. Because we thought in 2016 that the way to get on the president's good side was to get out of China.
And you
We
can see
didn't
the
know
move
that Vietnam
Nike
was...
had yesterday. Obviously, much of the move in Nike really of late has been on the very enthusiastic reaction to their conference call of last week,
Because
which
the
we talked
CEO
about a
was
lot.
CEO
where
talked about sports. It
where
was
they
great
said
that they
the
sit there
worst
and talk
is
about
behind them.
TTC.
As we head into the 4th of July weekend, we are expected again the vote on the big beautiful bill.
Right.
We're going to talk to Emily Wilkins in a moment, just to get the
good.
update from the Hill there. But beyond that, then we've got July 9th, and the question is to what other, at least close agreements will be in principle of some kind that will mean we won't see a snapback in reciprocal tariffs.
Right.
By the way, is that a concern to you at all in terms of what you look at the short term on the market?
Well, I just think that it's entirely possible that
amazingly, you're going to get deals, and those who are haggling, I mean, maybe Korea gets cut a little, but
Japan doesn't feel like it's as close.
Japan, no.
Based on recent reporting.
But Japan might be an outlier. I'm just saying that it might be. I'm in the media, so I have to be careful. But it may be going the president's way here.
The deals.
Yeah, maybe going the president's way.
And as for the market?
The market's very overbought. I don't like that. That's a technical thing, but it's more than 7 on the S&P oscillator, I find. We've had stocks that have just gone up endlessly on the same information. That always bothers me because that's multiple expansion. At the same time, the breadth of this market takes my breath away. I mean, the banks aren't supposed to rattle it. The banks are acting as if they are AI machines, and they're not even using much AI yet.
Not yet. And again, I do want to have that conversation with you. One of many we're going to have about.
You want to take it towards the commercial? You want to actually
loss.
have it on air?
I want to have it on air with you. But we got plenty of time today.
David, look at these stocks. Okay,
there was a piece about these are all. Many of them are new highs, if not all of them, if I'm not mistaken. Right? On the big banks.
But we have Prime Day coming up. Now, when you said July 9th, the first thing I didn't think about the big, the
trade deals.
No, I thought about it Prime.
Oh, really?
Yeah. And
got anything on your list there?
Said that Prime's going to be big.
It's going to be big.
And that Prime is an inflation fighter. So you have these numbers that come out, and they're not that inflationary, right? But they're not deflationary yet. So it's kind of like too late on time pat.
On time power. That's what you're going with? On time. So you're crossing out too late and replacing it with on time.
Why don't you can do an apology and say, look, I'm pressuring this guy too much. That would be amazing.
What?
If the president offered an apology.
Does that ever happen? Once? Let's get to President Trump's.
If you look
let Jim think about that for a while, and let's talk about President Trump's massive tax and spending cuts bill, of course, set up for a final passage vote. Overnight, Republicans did clear a procedural hurdle. The legislation is now advancing this after a group of GOP holdouts, they changed their minds. They voted in favor. House Minority Leader Hakeem Jeffries has been at the podium for quite some time, speaking out against the bill. He's at around the 4-hour mark now.
4-hour mark from here.
In terms of how long he's been speaking.
Wait, he's going to cut into the 10 or the 9?
He's not cutting into anything.
No, I'm saying, let's cut it. He's going to stop.
I have no idea how long he's going. I don't know what his plan is.
Where does he, I think?
Let's get to Emily Wilkins. She's got the latest for us in terms of when I guess we can expect to actually see the vote. Emily.
Hey, David. Well, we were initially told this morning that we should have seen the vote at around, the 6 o'clock, 5 o'clock hour. Clearly, that's not happening. Obviously, this is a very big moment for Republicans, for President Donald Trump to get his agenda passed. It's a huge, huge win that Republicans are going to be touting really for the rest of this year into the 2026 midterm campaign. So perhaps no surprise then that Democratic House Leader Hakeem Jeffries is taking this moment to steal a little bit of that spotlight and to make this speech. The last time when everything was reversed, when it was Democrats that were moving a major bill and it was Republicans that were in the House minority, you actually saw then Kevin McCarthy go for 8 hours and 32 minutes. So perhaps Jeffries is going for a record today. Perhaps we get something a little bit sooner than that. But look, either way, this bill is on the glide path to passage. We saw a very key vote that took place early this morning, basically just on the procedural. We saw all but one Republican vote for that. We've now heard from holdouts like Congressman Ralph Norman, who say, when I spoke with Trump, he made the argument that if any changes get made to the bill, it gets sent back to the Senate, where Trump argued it's only going to be made worse for your fiscal hawks. And so that was part of the reason that they agreed to just move forward with this now. Obviously, we knew that some form of this bill was always going to pass. Major tax package, making sure that there is not an increase on taxes at Americans for the end of the year, as well as other big priorities. Defense is in here, energy spending, border spending, all things that Republicans promised to deliver. And I think it's really just a matter of time now until that does pass the House and, of course, then gets to Trump before that July 4th deadline. Guys?
Well, it made his deadline as he was obviously wanted, and we'll get that. And so there have been no changes at all. Everything we discussed, obviously, in terms of the Senate bill remains. including, by the way, I would point, I know you've made this point, I just want to make it again. They did throw out that moratorium on doing any regulation of AI, so that's no longer in there. But everything else is. The wind and the solar, all the things that we've talked about impacting various stocks here as well.
Yes, I mean, the wind and solar, there were a lot of changes kind of making the timeline longer than shorter than longer than shorter. What they eventually wound up as is that the companies can get these tax credits as long as they begin construction by 2027. We should also note, because it has been discussed a little bit on here, we talked about that revenge tax, that up to 20 or 15%, depending what version you are looking at, tax on multinational corporations as well as investors from companies that had put a retaliatory tax on the U.S. That, of course, also been taken out of the bill at this point. So a couple of last-minute changes there. Certainly, though, a lot that is still in this bill in terms of taxes that a lot of the business community wanted to see. A lot that's in there. If you are a middle-class individual in a high-tax state, you now have a higher SALT cap, a higher SALT deduction that you can take for the next couple of years. That was a really hard-fought victory for this. And then just another, that there are so many different provisions within this nearly 1,000-page bill. But I think for at least some of the key ones, the back and forth, at least you did no more AI moratorium on that. Of course, it will be interesting now to see if that encourages lawmakers here in the Capitol to actually pass federal legislation that could preempt some of those state laws, because that's the real concern, that as states begin to implement their own AI laws, there's a patchwork. That's a lot of things that AI companies want to avoid right now.
Got it. Emily will be watching and waiting, of course, for when it actually when the voting begins. Keem Jeffries obviously continues, and that was a great little bit of information that McCarthy went over 8 hours.
Right. So now look, I think this 1,000. We got to take this home this weekend, and you got to look for the anomalies, because there's money to be made. There's stocks that we aren't thinking about right now. We're focused on a few solar stocks and some wind stocks. But this thing probably is a giveaway for a bunch of companies that we haven't thought about yet.
Well, you talked about some of the big stuff, which is the depreciation.
Yeah, I mean, that's just
immediate. I mean, 100%, right?
Yeah,
like write it off.
I think people look, it's accounting and therefore it's boring. But if you're going to reshore, this just gave you the green light of like, let's just start building right now.
You can write it off immediately.
Yes.
Year one.
I mean, I saw
right?
some story about Samsung's delaying completion of a chip plan for lack of customers, but that's not what I'm talking about. I'm talking about American companies saying, you know what, this is a giveaway. I got to start building. And that's going to happen. And that is, like it or not, if you do it with Rockwell Automation, say, it's pretty good.
Yeah.
Rockwell Automation is doing incredibly well, and that's who you might call.
Speaking of building, let's move on to the AI front, and it is specific to a lot of building that is going on. Published reports saying OpenAI has agreed to a $30 billion deal. It would rent 4.5 gigawatts of computing power from Oracle. Remember, that's how we measure it now. It's how much energy does it consume. And that will help it develop multiple data centers throughout the U.S. It marks an expansion of the Stargate project. Remember, OpenAI launched that. Of course, its key partner is SoftBank, Oracle as well, I think it's MGX. Back in January. Now, the 4.5 gigawatts, that's the equivalent to roughly a quarter of the current operational data capacity in the United States. Every gigawatt, sometimes it's equivalent to 750,000 homes.
4.5.
So, yeah, I mean, you're talking about a medium-sized city.
That's why this is the revolution. This is the other part of the revolution that Jensen talked about, which is that, look, you got to power this stuff. And when you speak to a lot of these companies, that's what comes up first, power. So I mean,
it always comes up. We've talked about it endlessly.
Right.
We will continue to. It is the gating issue.
I mean,
It's still a question in terms of how quickly the grid can keep up. I've talked often about Elon Musk's efforts in Memphis, for example. I mentioned that company the other day because, I mean, there you're talking about the same kind of thing. The Memphis Chamber of Commerce, XAI has chosen a site in Memphis to build this new supercomputer, and they've got to get it powered also. I'm just looking here because I'm looking back at some notes I have on it in terms of getting the permits, getting everything in place. That's what you're dealing with.
I mean, you're going to see
when it comes to powering all of this.
Like, yeah, obviously, the president wants accelerated permits everywhere, and there's a federal judge could he's going to start harassing federal judges who get in his way. Why not?
Yep.
And I do think that we when I speak to Andy Jassy, CEO of Amazon earlier this week, he's talking about the belt of the Pittsburgh belt. I mean, David, Pittsburgh's a great city, and they've had more business come away than go to. But now there's a Pittsburgh Bell. Maybe it's related to Carnegie Mellon, and it's going to be a giant construction site. Susquehanna, near where I grew up, there's a nuclear power plant. Amazon took a lot of land. I mean, this is what's happening. Entergy. You're seeing.
Yes,
Louisiana,
areas where you can get power. You can get a decent amount of power, and you can get it to the site.
Right, but we aren't talking about it. It's this grid revolution.
We are talking about it. What do you mean we're not talking about it? We talk about it every day.
Companies.
Well, I'll leave that to you.
Well,
that's your job.
Social studies class?
That's your job, man.
This is social studies. Okay, let's talk about Marx. No, I mean, it's Emerson.
No more Marx.
Okay, let's talk about, I don't know, Wendell Willkie, G.E. Vernova. What? Willkie. Hey, he can't. One world, man.
We'll be talking
you
about
study Willkie lately?
We're going to be talking about engineering.
Did you study how good Willkie was?
Here in New York, we're going to be talking about...
Immediately endorsed Roosevelt. Immediately endorsed Roosevelt.
Got it. All right, take a look at futures. Remember, it's a shortened session today. 1 p.m. end to trading, so get ready. We open at 9:30 as usual. That's 13 minutes from now. We are looking for a slightly higher open. A lot more squawk in the street straight ahead.
Now.
All right, take a look at some of the gainers as we get ready to open 10 minutes from now. We're going to talk a bit about Cadence and Synopsys. They're two of the names as a result of that U.S. lifting a chip design software curbs on China as part of the developing trade deal between the two countries. Jim and I will talk a bit more about that. But first, we'll get Jim's Mad Dash. Right to this. All right, let's get to it. The last Mad Dash for the week.
Yeah.
Where do you want to go?
Okay, I very much like, I preface this, Laura Martin's work in Needham. It's very provocative. But she had a sell on Meta, and today she had to upgrade it. I don't know if she had to upgrade it. You pick today. Now, what matters here, David, is that she was worried about costs. She was worried that rapidly rising Reality Labs losses would matter. And what's incredible is they haven't. And they haven't because she does say, listen, they got a great model. They don't pay for content, software only, free riders on mobile devices, closed loop attribution for advertisers. All these things are true. And they have used AI, I'll go one step further. They have used AI in a way that is so fabulous that you really, no one's ever experienced it.
And using the AI in terms of the products that they offer advertisers, for example, or are starting to. Because then there's the other side of AI in their business, which we've been focused on, namely how many employees of OpenAI Zuckerberg has been targeting or trying as he tries to build the ranks in terms of artificial intelligence expertise of the company.
And she does say, you know, that's one of the reasons why she doesn't go to a buys. But that is, you can't go sell a buy without everyone talking about it. So,
yeah, but you had a really bad call on this. This has not been a company you've wanted to not own, right? Let's go back a little bit. I mean, we got 1 year at 41%.
I'm an ambassador of goodwill, and I'm trying to see the positive.
Really?
No, it was a really bad call.
Yeah.
But I do think that when we look at Meta, we keep forgetting the fact that this guy is a multiple expand. We haven't talked WhatsApp. I mean, look, WhatsApp's probably worth half the company. People, David, if you go to another country, people don't use any.
That is true. That is true. It is widely used, especially outside the U.S.
Right, when my Brioni guy calls me, it's always on. It's WhatsApp.
There was that inflection point. I won't bring it up too much, but there it was.
I want you to see.
We're not happy with him there.
No, I wasn't. But this is a 210 that I will garden in later today.
You look good.
Thank you. I'm going to garden in this later today.
Oh, good.
Yeah, because I like to garden in Brioni and stuff like that. I'm going to Hermes tie, which is very good luck.
I like the pictures of you in your suit and tie, on your knees in the garden.
I'm going to be trying to prune the tomatoes.
All right, we got a lot more for you. Don't go anywhere. By the way, you can catch us anytime and anywhere by listening to and following the Squawk on the Street Opening Bell podcast. Speaking of opening bells, we got one 4 minutes from now. right, we got 1 minute before we get started with trading here. Going to digest a jobs report that, as we told you at the top of the hour, of course, was better than expected. 147,000 jobs were added, and you can get a little deeper in it and start to say, well, is the private sector really doing its part? But the number was better. Yields moved higher, Jim.
Yeah.
But stocks have maintained a positive bid this morning, despite that move higher in yields.
Yeah, and look, you do have semis going up again. It's a rather amazing thing that's going on that people aren't talking about. We were always in the last 10 years, it was software that moved up. ServiceNow, a Salesforce. Now it's semis and semi-equipment. And I think that this is a big change. From Jensen Young, who runs into me and was saying, listen, you have to understand, this is the semi-time. And I know Jensen feels this is the semi-time.
Let's talk about that in a moment. Let me do the honors here. You just heard the opening bell. Take a look at the real-time exchange here at the big board. Sale for 250. We're counting down now to the 250th anniversary, of course, of not just the country, but the Port of New York and New Jersey. That'll be July 4th next year. A lot of tall ships, apparently. Yeah. Similar to what we had, of course, Operation Sail back almost 49 years ago here in New York. Over at the NASDAQ, Arrive AI, that's an autonomous delivery network celebrating a recent listing.
A lot of listings, David. A lot of listings, and we know it's all easier. The deregulation is a story we don't talk about enough because you get a FERC, okay? FERC is deregulating like mad, and that is going to eventually impact companies like a Wano, which is where number was. You've got people raising price targets. I mean, the natural gas, all the pipelines, the oil pipelines, they're all being deregulated, and FERC had been very tough. So you take it's the agencies, and I remember when you and I talked about Biden was elected, you said, don't forget, it's the agencies are going to have the power. The agencies reflect the president's judgment. Well, the agencies are so in to the president's judgment that you saw an FT article about how Goldman Sachs was able to do incredibly well on the stress test because they lowered the standards so much.
Yeah, they changed the standards to a certain extent, and all of the banks came out with very strong results as a result of that. And in fact, were able to have excess capital, which we talked about yesterday.
But
and much of that coming back to shareholders in the way of dividend increases as opposed to just straight buybacks.
33% when it comes to Goldman.
Today it's sort of a mixed bag, but we pointed out these banks have had quite a move of late. And the group overall has performed very well. I mean, J.P. Morgan now is more than an $800 billion market cap.
But that's finally right. I mean, we know, you know James Dunn better than anybody in the media. They built a powerhouse, and it wasn't reflected in either the price to earnings multiple or price to book, and now it's being reflected because that is a worldwide leader.
It is. And there's Goldman, of course, also, basically right around new highs, up some 25%. This year. Interesting story in the Journal about J.P. Morgan and their continued focus, or even more focus on the highest net worth individuals and what they can do around the world, not just in the U.S.
That's the Goldman strategy, that hunt for elephants. I like when Morgan Stanley graduated, you start with like an E-Trade or younger people at great American companies that are about to go public, and then you take them up to what is really a great wealth management fortune, trillions of dollars. I find that BlackRock is the one that no one talks about.
And why do you think that is?
Well, because it's wrong. I mean, they should be talking about what they're doing in infrastructure, which is very important. Today there's a story about maybe they're going to monetize some Saudi Aramco stuff, and nobody even cares.
I mean, BlackRock is very much focused as well on figuring out various products that can
bring
the infrastructure credit to the masses, so to speak, and private equity, but the entire private markets to a broader array of investors.
Well,
it's not the most easy of things to solve, but they're in the midst of doing that.
You've got an infrastructure fund for 401k that's producing remarkable returns.
Yeah.
And I think that that's something that a lot of people probably want to be in. I tried to get in for individuals.
This is, again, back to infrastructure. You need the capital to help build all the to finance the building of data centers and the power that finances them and everything else associated with them. Right there, you're talking about hundreds and hundreds of billions of dollars in capital
It's a
that is needed.
revolution in spending.
Yeah.
And that's one of the reasons why I'm trying to get a little more idea focus for our viewers.
Yeah.
Because it's very rare that you ever have a tsunami of money coming in to a business that hasn't really been.
No, and what people like in the private credit part of that, in terms of the data center business, is the credits you're taking on are Meta, Microsoft, Amazon. You're talking about the best of the best.
Right. Much
And
better
so,
than the credit of the United States.
you can get a decent return, which they can generate, and you're Apollo and you're looking to help finance one of these data centers that Meta is buying, is all the computers for them.
Right.
But yeah, it's a great deal.
It is.
And so they'll do it all day long.
Do you remember when Larry Culp, CEO of GE Aerospace, was very apologetic about GE Vernova because windmills, turbines have been, the accounting for turbines had been somewhat disturbing in a previous regime. And he said, look, don't worry, it'll get a good credit. GE Vernova at 500, it could double.
It could what?
It could double.
Well, yeah, it could, but over
It's
a reasonable
139
time.
billion.
Okay, so you
Yes.
think what?
Well, yes, but they're not expanding the way I want them to. Scott
How come we haven't talked at all though about the lack of? That all the subsidies for wind, where they played important roles,
Well, that's why
have gone away.
But they do seem to favor something in favors of America.
They do,
And
but
they make
it still conceivably will have a depressive effect on the capital
Yes,
moving
it
into
will.
that area, and so
Yes,
you
it
won't
will.
have as many of these things being built in general.
I'm hoping it forces them, and they've been reluctant to do so, to open new plants to make turbines. Because the turbine shortage is incredible, and they cost $50 million. So if you're one of these countries that Liberation Day got hurt, you could call GE Vernova and say, listen, I need 10 turbines. And then you go to the president and say, hey, listen, I'm changing that balance right now. That's going to replace airlines.
By the way, when he says turbine, he really means turbine, just to be clear here. He's not talking about he's talking about a giant thing that's...
What, do people think I'm just wrong?
Nobody has any idea what
GE calls them turbines. I've gone over this with them many times.
You've gone over with me. You know what? I come back to the same jokes time and again.
And I like them. Because remember, the late Roger Ailes told me that the American people haven't heard it until it's said 18 times.
Exactly. And we test that all the time. Because we say the same things
But I think GE Vernova being, if they expanded, if they put up more factories, which they haven't because historically they've been fooled by this, you have a $139 billion company, you have a $260 billion company.
Okay. Jim, we haven't gotten to, not that much news this morning, but there is some in this U.S. lifting of the chip design software curbs on China as part of the trade deal. So you had these export license requirements for chip design software sales in China, and they're going away. And we've heard that and been confirmed by the likes of Synopsys, Cadence Design, Siemens as well. Synopsys said we received a letter from the Bureau of Industry and Security of the Department of Commerce informing Synopsys that the export restrictions related to China have now been rescinded, effective immediately. And you can see the impact. Not that great, but it's something.
It's huge. And I've got to tell you, these partners, they're number one. These companies, their number one partnerships are with NVIDIA. That NVIDIA does chips for them,
right?
And they do software for NVIDIA. So my question is, when I put this already to the CEOs, both Synopsys and Cadence, is where's NVIDIA? And Dr. Anirudh Devgan, who is just so, he's just terrific. He's the CEO of Cadence.
Yeah.
And then we have, I'm looking, what was that?
Somebody dropped
That was
something.
disturbing.
Yeah.
But when you see Mr. Sasha Ghazi, he's Synopsys, and you say to yourself, are you kidding me? Do you really think that this is not going to lead to NVIDIA coming in? I mean, these companies are like this with NVIDIA. I spent a lot of time
So
with
you
GTC.
view this as a positive sign for NVIDIA's ability to go back to selling chips in China. Is that what I'm picking up here?
Well, I've got to tell you, I can't get it confirmed. I've already tried to get it confirmed this morning.
Because that would be, obviously, we talked a lot about the market there. Now, By the way, the Chinese are making their own chips, not as powerful, not as strong.
Not this.
But they are certainly not quite matching our own, but they are very competitive in AI overall.
When it comes to cadence and synopsis, they are nowhere.
Interesting.
Yes.
Right. Now we should point out again, back to the trade agreement that was. Remember, they had it in Geneva, then they reached it. Then they kind of reached it in London. Or was it? I always forget which.
I don't know, but London's going to have to deliver on this.
Right, and so now we hope also that they're delivering on the rare earths.
Right, but this is to me.
Again,
to me,
they were not really delivering on as they were supposed to have after the initial discussions of a deal.
You give them cadence and synopsis. You're giving them NVIDIA. NVIDIA is look, they're the software for the hardware. There's NVIDIA. You can't make the big Blackwell chips without these companies. That's the latest and greatest NVIDIA. So I think it's logical to assume that maybe something is brewing with NVIDIA. I don't know. But you're getting a lot of NVIDIA if you let in cadence and synopsis.
It's a big call.
You're getting a lot of their stuff. They're hand in glove.
I'm here.
And I don't think people seem to realize this.
Okay.
Oh, looks like we had a breakout.
I only know because I interviewed. Okay. Jensen told me to interview them. I interviewed them. They were fantastic. They were great companies. Right. We have some amazing companies in this country that we don't salute. And those two CEOs I mentioned are brilliant guys.
Okay.
Now, David, I had a company on last night called the Metals Company.
Oh yeah, I recall you teasing that.
Right.
What did they have to talk about?
Vancouver, BC, where I was with my kids. Well, they're just trying to get rare minerals from the
Is this a speculative company?
And this is what I want to talk about. I brought them on because people keep asking about this stuff. Dan Ives recommends this.
I'm here.
On the board.
Okay.
They've got enough money to be able to do things. They kind of vacuum the minerals up. David, I would never put this company on a hearing. I just wouldn't. But we live in a crazy time.
We
maybe
you are supposed to make editorial judgments of your own based on your own experience and making a decision as to whether to give somebody the platform of your show. So
500%.
I hope you did that. I assume you did.
I did what any responsible journalist would say. He said, I think this is a very risky stock. He disagreed with me.
Yep.
But what do you do when you have viewers who are frantic about getting into the metals company because they get the minerals from the ocean floor, and where the president allows it to be drilled? Remember, the president encouraged this company. In the Daniel Ives piece from Wedbush, we have him on. He's a fashion plate. And it's a very positive note.
Nice little breakout again.
Dan Ives have the time to cover this company when he's covering the rest of corporate America.
I read it. I said, geez, Dan Ives likes this. Now, I mention all this because I'm stuck with viewers who called me about this, Joe B. Archer, and I had Akla, and I've got to study them. I have to present this company. I can't make a judgment.
Even if it's bad news that you ultimately present to them, Jim?
I don't know whether it's bad news.
And say, I don't buy it, I don't believe it, I don't see it. I'm not saying you do
or
don't.
I was critical, but I think that this is an era where you can't just say, that's a SPAC that makes no sense. When the president has said, look, I am encouraging people to drill in the ocean floor to bring up rare minerals. Yep. And this company has taken it upon itself to do that. Now, I could easily say, well, forget them. I got to wait until Caterpillar wants to do it. But I can't say no to our viewers anymore. It's a $2.4 billion company.
All right.
Well, no, don't dismiss me.
I'm not dismissing you. I think it's a dangerous road. You know that. And you can sit here and say, well, I sent the stock up a lot. And at the same time, 2 weeks later, I'll say, well, I'm sorry I did that. Because ultimately, this is not a company that is deserving of that. I'm not saying that's anything, but that happens.
Are you going to use our audience to raise money?
Right.
I wouldn't like that.
And they did it.
You said no.
And then they did.
And that was AeroVironment.
Yes,
I'm saying
AeroVironment.
that the metals company.
Oh. All right, can we move on for a second? Because I want you to put on your philosophy.
It's about the temper of
I want you to put on your philosopher's hat for a second, if you're capable of that, as we wrap up sort of this part of the show. The story in the Journal today, CEOs start saying the quiet part out loud, AI will wipe out jobs. And one of the focuses is your friend Jim Farley, who's always outspoken and willing to say things that many CEOs are not.
Stock be flying.
Okay, we got the SPX put here.
Now there are obviously a lot of people on both sides of this debate in terms of what the.
We got SPX put double top at the orb at $2.15.
Whose jobs could be impacted, bankers,
It hasn't happened yet.
62.30.
Not yet, but could it be coming, and will it be coming? And by the way, the profitability of corporate America will be greatly enhanced, conceivably, by the efficiencies introduced. But you do wonder, at what point does it become a larger conversation? If this happens, if we have 20%, 30% of the workforce suddenly being displaced,
Well, I think you'll
at
see-
high-end jobs, do we have a conversation around capitalism? What's our system going to look like?
I think it's a great issue. It's the issue of our day, because are you going to go to law school and get out and there'll be no jobs because, or very few jobs, because the lawyers are using AI to do indentures and not using very expensive people to proofread? I mean, that could certainly happen. The auditors, one day it could, but there's a big shortage of auditors. Maybe it would help them. But I come back to what NVIDIA says, which is that these people will now be empowered to create new companies, and ultimately there'll be more jobs created. I really believe that.
You believe that?
Yes, I do. In my heart and soul, I believe that it's very positive for entrepreneurs and entrepreneurial systems. People, look at Intuit. Intuit is probably, I think, the company that's using. I know Mark Benioff's going to say he's using it, but I think Intuit's using the most AI, and it's using it to help small business.
Yeah.
Like
Programmer, designer, product manager, data scientist, lawyer,
62,
customer support rep, salesperson,
30,
finance person. AI is coming for you.
Yes, it is, but it's just not there yet. I think the level of trust of AI is not as high as people say it is. When I read Jim saying that, Jim Farley, I said, well, people are going to buy his stock if that's the case because they have a lot of white-collar workforce. But this is the question I asked Jassy, and he punted on it. Is it better to have a 2-year degree where your specialty is something that is in short supply, or is it better to have a 4-year degree where you studied English and, like, wow.
I think better to have an English degree these days than one in computer science. It's completely flipped.
What are you going to do with those? I don't start.
Well, I think English. You could,
Tesla might be out of support for a scalp.
My own book here, but you at least can.
But my dad was
try and have some understanding of the world and/or
Tesla. Mr. up 363, $4. I don't know what to say. $175 now.
that was serviced. The composite actually improved by a 10 from 52.8 to 52.9. Also hasn't been below 50 since Jan of 23. This is the best since just May of this year. But these are pretty good numbers, so the final reads did move just a smidge. ISM, factory orders, durable goods, top of the hour, 147,000, a very solid jobs report. Unemployment rate drops to 4.1. We're seeing the equity market strong. We're seeing interest rates up, and well, you're not going to be seeing squawk on the street for about a minute or two because we're going to take a very short break.
New high. I think about bumping in these puts, but $165. Drop. We get all the way down to the 9 for a double bottom. Oh, what? God. Well, that sucked.
Rated PG-13.
From President Trump's, of course, massive bill, otherwise known as the Big Beautiful Bill, to the July 9th tariff deadline. Yep, don't miss it. Interview with that man, Treasury Secretary Scott Bessent.
Very level-headed, very smart. I really like it.
That will be on Money Movers this morning, 11:30 Eastern. Speaking of President's bill, next week Leslie Picker is going to explain what is at stake if the U.S. doesn't rein in the budget deficit. Be all-day coverage as well.
That's going to be
special
fabulous.
Report.
America's fabulous. Leslie does a fantastic job.
Reckoning. That's all day Monday right here on CNBC. Up next, Stop Trading with Jim.
It's moving up. IWM bounced off the 200s. Well.
All right, what do you got to wrap up
There's
the
no
week?
second acts when it comes to business. July 19th, the world stood still. 8 million PCs went black because of a glitch caused by CrowdStrike. The stock was at 279. Well, this morning with the stock at 509, Wedbush, Dan Ives, this is my Dan Ives day, raises his price target from 525 to 575. There are a lot of people who felt this company was finished.
Well, not you. To be fair, because I am your biggest critic, but also your biggest supporter.
Sure.
And you were positive throughout there. I mean, you mentioned Le Mans at least 1,000 times too many.
He won Le Mans.
But you did make the point that you thought they would get through it.
Yes.
And you were right.
And I just think, I salute George, and I think he went and visited every client. There's some people who feel that he lost no one other than Delta.
And you had him on, you gave him a relatively tough
He wanted to come on our show and say, listen, I screwed up. Apology.
Have a good weekend gardening.
Hey, you just
tweet out some pictures of you in the suit and tie.
I'm going to have to change. I think I have to go to I don't know. What do you think? Change the tie?
Yeah, get a tie that has like tomatoes on it.
Maybe tie with a bigger thing.
Yeah.
The Ferragamo's the one they give me, so I'll probably wear that.
But enjoy.
The
Mr. Newhigh.
over $3,500 if it gets above that 1350 level. Break even 1350 on the outside. That's about 2.5% above the current share price. So you don't need a monster move to the upside. And I mentioned that flexibility as far as trade management goes, Alex. If the stock starts to rise into that earnings event, maybe gets above your break even, maybe this thing expands to $35, $40 ahead of the report. Well, if you bought 10 of these spreads, you can start parsing back some of your position, or you can close the whole thing. The market's open. And I think that's one of the keys with this type of directional bias trade is, yeah, there's implied volatility levels that are elevated, but hey, you don't have to wait until earnings event to get out of this, but it still has that directional bias where you need to move to the upside.
Earnings 2 weeks from today. So as we say goodbye to one earnings season just a week or so ago, the other one's just around the corner. Tom, before I let you go, up 36, looks pretty nice. All-time highs, record-setting day. So while it's a shorter day, certainly a little bit more action-packed, I think some thought. What'd you make of the start of the day, first half hour under the belt?
Yeah, you know, the momentum, I think, has been hard to break. The Bears have been wrong on this spectacular rally back. You see the parabolic move to all-time highs now for the NASDAQ and S&P 500, Dow getting close, is the fact that it's hard to stop that momentum in this slow summer trade, right? It seems like before we hit those all-time highs, that the market was ignoring good news or bad news and grabbing a hold of good news. Now we're getting more wins as far as headline risks go. The jobs number better than expected. Unemployment rate actually dropped instead of going higher to 4.3, it went down to 4.1%. So those are positives for the markets. If this bill gets through, the tax bill gets through, that might be another positive. The market's kind of hooking their wagon to. And then on top of that, you got the July 9th trade deadline at this point. And will we get more deals? We've got the UK done. Vietnam is supposedly supposed to be done. We don't have clarity on that yet. But that's the next mission. And it's a bunch of wins on the headlines. And I think that's propelling this. And then you got the wealth effect with the market at all-time highs. That probably means the economy is going to really start to pick up steam as people will probably continue to spend, job market's robust. So there's a lot of factors and catalysts that have created these new all-time highs. The only thing I'd be a little bit wary about is the fact that on a technical basis, on a valuation basis, we're starting to get a little bit expensive, overbought on some RSI levels. Forward-looking PE on the S&P 500 near the 22 level. That's historically really elevated at this point. So watch earnings season, Alex. I think that's going to be one of the catalysts. That's got to be supportive of where stocks are right now.
I'm keeping you over time. We got ISM Services that just hit the wire. You want to do some instant reaction with you? I'll
Sure.
give you the numbers. You tell me what you think
Okay.
here. Right now, S&P's up 40, so that might be giving it away.
Yeah.
Services index was expected at 50.6. Its prior was 49.9. It comes in at 50.8.
Yeah.
Prices paid 68.7 last time. Expected to uptick to 68.9. 67.5. We're down. And then also new orders swinging from 46.4 to 51.3. Expansion.
NVIDIA new high.
Expected to still be contracting at 48.2. So all that to be said, better than expected headline.
Yep.
More orders
Yeah.
going forward. And prices paid is a little bit lower. This
Yeah.
sounds about like if you could have just said, hey, if I can make the perfect ISM services reasonably, this is what you make.
Yeah, Goldilocks on top of good jobs number, right? And then the PMI manufacturing, ISM manufacturing earlier in the week, a little bit better than expected. So it just goes back to those wins that the market's creating right now. And that's helping propel us to these record highs. And not surprising that the service sector is starting to expand once again. We've gotten through a lot of the tariff headlines and headline risks on that front, where maybe the economy can start to expand more than what the Fed's predicting, more than what the market's already predicting. But as I mentioned before, you got to start being cautious here because it seems like we're getting a lot of wins. All it takes is one little knock that could draw us back down. But at the point right now, it's hard to bet against this momentum that we're seeing in the markets right now.
Well, now it's got reasons behind it too, and I always think that can make for a scary. You got a lot of things working together right now. Seasonality, quieter, and now there's fundamental backing. There's just not a lot to get in the way right now. Doesn't mean that in a week and a half, 2 weeks, earnings come in, something can't change. But Tom, make sure you check out Tom later on, coming up for Fast Market. I'm sure they got a good show with plenty of things trading related on their minds. We're into hour 2. Let's take a quick look at where the S&P 500 sits.
Hour
we
2.
did talk about this reaction as the S&P works towards records. S&P 500 up 42 points. NASDAQ 100 up 185. If you look at this on a performance from a percentage standpoint, 0.7%, or about 2/3 of 1%, I should say, for the S&P, 0.8% for the NASDAQ and the Russell, as both those markets continue to surge. And this is a new record for the NASDAQ 100 as well, as it joins the party with the S&P 500. I want to welcome in George Tillis to get some more live reaction here as we just got the ISM Services print. George, to the floor, sir. We said Goldilocks. What say you?
Well, I agree with you. I mean, if you just consider what's happening, I mean, this is a pretty remarkable news day. Everything from labor market conditions, better than expected, unemployment to the downside. If you look at the ISM Services numbers, they were higher than expected. The other thing is factory orders also were a little bit higher than expected, 8.2% versus 8.1%. I think this is essentially a demand pull effect based on tariff fears going back a couple months. So factory orders are improving. I just think the fiscal conditions too are very strong.
Yes, they are.
Consider the Senate bill, the big beautiful bill, which eventually will get passed. They're just ironing out some details in the House to make concessions to, of course, representatives who are going to be voting for this bill. It's a very large bill, and so it's a very large spending bill. It's a very large tax concession bill, and that's accretive to the economy. And so, for what it's worth, right now, I think that interest rates, everyone's looking at it as a panacea. For instance, looking at lower interest rates. But I look at all the other conditions. The economy is strong. Labor markets are still sound. They could be better, but they also could be worse. I think the fiscal conditions right now are still very strong, and that's really pulling the economy forward.
George, it's almost like if you're doing multi-factor analysis right now, that seemingly everything points to optimism relative to just a few months ago, but you're paying for it. That's the big hurdle, I think, for many. At least if you're looking, top line, market cap weighted S&P 500, Nasdaq, or some of these winning stocks. But under the hood, it certainly hasn't made a high. The Dow hasn't made a high. The Russell hasn't made a high. International stocks are turning around, but on a relative basis, still underperforming quite a bit. One of my guests talked about rotating into other areas. Give tech a second to maybe take a breather. As someone who does have a little bit more of a longer-term view than some of our others on our roster here, George, how does one digest the high valuations, but then also describe a point that kind of warrants it?
Well, I think right now, from a tactical standpoint, you have to consider the easy money's been made since the April lows, because topping formations in markets are very complex. I suggest we may be presenting ourselves or be in a trading range for a little while. So with that said, in a trading range, there's a lot of opportunities to be had or made based on divergences between performance. And if that's in mega caps, maybe we'll see some of the other mega caps, for instance, start to outperform. I'm going to put Apple in that camp, maybe Google. These are two names that haven't performed very well this year. NVIDIA is higher, Broadcom is significantly higher. So my point is that right now, to generate some
NVIDIA new high
portfolio is to look for sector rotation, relative strength, underperformance. Maybe the Russell 2000 is an area to keep in mind. I talked about the material sector. Yesterday, it's starting to break out of a 200-day moving average range, as well as the fact that it's going to be a benefactor of the fiscal bill. So this is where the challenge really lies right now, at least from a tactical standpoint and an investment standpoint. So yeah, there's a lot of extreme movements in stocks right now, particularly in the frothy areas of the technology stack, quantum computing, maybe some of the altcoin, or if you will, stablecoin stocks, but maybe we'll see some healthy rotation in other areas of the technology stack to help balance things out a bit. But nonetheless, Alex, I do think that the economic conditions really are very strong. We still have higher than necessary inflation, but that's creating profit opportunities for companies. At the same time, you got to think about higher interest rates, which are still above 4% on the 10-year. That signifies the demand for investment is very strong. And so right now, there are pockets of weakness, particularly in the housing market. But you have to keep in mind that the housing market sustains the labor market. Factories produce goods that we actually need, and that's essentially what I see as strong right now, particularly in the factory orders, manufacturing, and so on.
Really, really light volume day as expected on a holiday shortened day into a long weekend, George. But we just had the heat map up. There is a lot of green boxes on the board here today. No real bright colors, but about 70% of the S&P 500 components advancing on the session. So a really, really powerful way to end the week as we hit records. If we were to close here, S&P and NASDAQ 100. George Tillis, appreciate it as always. We'll talk again here soon at the end of the hour for the panel. As we say goodbye to George, I want to welcome in our next guest. That's Jeff Pierce. You guys know Jeff well. He's the Senior Manager of Derivatives Trading at Charles Schwab. Jeff, we're matching here on this Thursday. Good to see you, my friend. Let's talk Oracle. This was a lead story for me yesterday on Market on Close. This broke about 15 minutes before the show started. OpenAI buying some gigawatts from Oracle as Oracle's become a big-time player in this cloud infrastructure space.
And it's really starting to show through over the last couple months. I mean, if you look at the chart, a very slow start to 2025, trading around $118 in April. Now we've seen them rally of over 30% in June, seeing the stock trading above 230. It's been pretty incredible, and it is because of these sort of stories. OpenAI, as you pointed out, going to lease about 4.5 gigawatts of computing power from Oracle. We know it's part of that Stargate project, which includes Oracle, OpenAI, and SoftBank. They're proposing investing about $500 billion to build out data centers in the U.S. and globally. as we look at kind of what Stargate's been gone through and some of the hype around it, if we look back in January, President Donald Trump formally announced the Stargate project. We've seen the venture continue to include more and more spending. And this comes after Oracle has already said that they signed a multi-large cloud service agreement that they're expecting to contribute more than $30 billion in annual revenue starting in fiscal 2028. They didn't announce the client, but Wednesday, Bloomberg reported that the Stargate agreement would make up at least part of this. Again, an incredible run from a database software company now going into cloud. We're seeing a lot of revenue. Cloud was up 24% in fiscal 2025 for Oracle. We're seeing that revenue really jump. It's about now if they can continue to compete against some of the big names.
And when you look at this, the stock's doubled from the lows, Jeff. It's just incredible. We're not talking about, a startup company. We're talking about one of the bigger companies on planet Earth that almost had a legacy stigma to it. Well, maybe you want to take that off. I said this the other day. It caught me off guard, but it's joined my watch list, and my watch list got names like Palantir on it. So I put it in that camp almost now, which to me, I mean that, with love. I mean, if you're on this list, you're a moving stock and you're one you got to pay attention to in my mind. Jeff, final thoughts on this move we've seen in Oracle. Did it catch you off guard?
I mean, it did. I mean, they've been transforming this business, and there was a lot of concern, like what you mentioned. But now when you're seeing expectations for cloud infrastructure revenue to grow 70% during fiscal 2026, when we're seeing the kind of spend and return that they've gotten from cloud, up 52% growth in cloud infrastructure in Q4. I think there's a reason behind the hype. I think investors have to be worried about the spend. A lot of CapEx there. Of course, that's going to put some pressure on gross margins. But overall, the optimism, I think, has been strong for a reason, and it's showing again today with today's story, or this week's story, I should say.
Good stuff. Jeff Pierce, Senior Manager, Derivatives Trading. You enjoy the long weekend, my friend. We'll catch up here soon in the coming weeks. As we say goodbye to Jeff, we welcome in Joe Teagay, Portfolio Manager of the Rational Equity Armor Fund. And Joe, you have the fun job of looking at a stock that's doubled over the last, 3 months or so, and trying to figure out how to trade it. Certainly in the momentum factor now. First, what's your thoughts on Oracle given this move? And then we'll get into your example trade.
Yeah, thanks for having me. I was just on the Big Three on Tuesday, just 2 days ago. I was saying, boy, this has come a long way over a short period of time, and I was still bullish on it then. I'm still bullish on it today. My trade on Tuesday was some sort of call diagonal. I called it a poor man's covered call strategy. Similar trade still outlook today. I'm very bullish still on cloud. Looking at Oracle, everyone's talking about this AI cloud that Oracle is mixing up with Amazon and Microsoft in. And there's just a huge market to tap into here. Yes, Microsoft and Amazon have the lead, but it doesn't even matter. People are growing so much in their companies, like OpenAI, that might not want to partner up with Amazon and might want a different partner. And Oracle's filling that void. And I think this deal with OpenAI is really important. Yes, they got a $30 billion deal. Yes, that's huge. But I think it just sets them up for a huge layer of growth in the cloud. They can make a bigger margin on the smaller customers. They can just build out their data centers right now as they're doing so. So I think this is just fantastic news. In the midst of a great bull run for the stock market, AI obviously is leading the way, and I think it's really exciting to see all this happen.
Joe, I love the call out too of not only are they working with some of the bigger hyperscaler companies that they have been for decades, but they have an offering that's accessible to small and medium enterprises. It just expands their potential, business market share tremendously. They're competing on price pretty aggressively with companies like Microsoft as well. And they all just integrate also well. All these companies,
Not so rebound on AMD just now.
Well, also. Talk to us about your example trade.
I think I just mentioned that.
A couple days ago you had one. Obviously, if it was bullish and the stock continues moving higher, that one's probably already working for investors. But for those who didn't see that segment, or how is your opinion?
AMD, nice reversal on this call that I mentioned. Don't understand the meta. Meta 3 black crows right here. Meta's growth sizzles. But wait for a pullback before buying in. Meta analyst is no longer bearish. This was today, 2 upgrades. It looks kind of cheap to me too, but Meta. Well, there goes the buys. Can we see 160? NVIDIA. Go, look at her go. NVIDIA's on fire. Jimmy's got the sniffles. Nvidia new high 160.57. TSM new high. Crazy market. Ooh. New high on SPX. Crazy. Very nice. Mm-hmm. Yellow. I'm here. No, not flipping. Sleeping. Napping. Unless I flipped. Oh boy. Was I flipping and slipping? Everything's very bullish. So NVIDIA started to pull back, so did Apple a little bit here. And AMD's pulled back 50%. Nice little breakout pattern this morning. Snake breakout, pulled back, double bottom boom. Doo-doo. Okay. We got tomorrow off. Today's the last day. God. One trader this morning said on there that we're in a sideways market, might be trading a different way than what it's been trading. A lot of channels, a lot of patterns. Yeah. Boeing triple bottomed here up to 63. Crowd's going wild. Looks like a little bit of volume. Slash ES is having a good day. Randy. After the 3 minute. Little bits and little bits. Still moving. Always cleanest, Jim.
Hey Jim, it's Chris Wedge.
Yeah.
Sorry to bother you, but do you by chance have keys to that, to the part of the IRS building that we don't currently have leased?
Yeah.
You do?
Yes, I do.
Is there any way for you to come in sometime this morning? Because FMSS is here and they're talking about maybe leasing it again.
Yeah.
They need to look at it.
Okay. I'll just go down and unlock it.
Okay. Are you here?
Yeah, I'm in Springfield.
Okay. So what time do you think you'll be here?
Are you there now?
I'm at the building.
Yeah, it would take me 5 minutes.
Okay, appreciate it, Jim.
Okay.
All right, thanks.
Bye. I will be back.
Patterns that you recall from where consumers felt a certain way, but it wasn't necessarily the case in terms of the hard data.
Yeah, I mean, I think it echoes this post-COVID period in so many ways. You had this long...
What the heck is...
This is the most iconic play I've ever seen in softball history.
Where tariffs are sort of in the market but not hit completely, and they will definitely cause inflation to tick up. It will likely put the Fed on hold, as we're hearing, on rates for the time being, so that's another angle to it. And we see a hit to GDP in the range of 40 basis points from tariffs alone. So based on the 2018 tariff war, the lag should be in range of about 3 to 6 months, which should impact inventories for back to school and for the holiday. So there's sort of a reason why people feel a little hesitant, but things are pretty good. So there's a lot of, as your prior guest was saying with Meta, there's a lot of communication. People have a lot of transparency with what they're shopping for. So life goes on as the consumer goes.
Okay, let me ask you this, just to kind of look at the other side of the coin here. One of the numbers that stood out to me in the most recent jobs report, the number of people employed part-time for economic reasons was 4.5 million, right? So that didn't change a lot actually in June. They're looking for full-time, but they're working part-time. They're unable to find full-time, or their hours have been reduced. So that's the situation there. I wonder if that is kind of behind what we're seeing in some of the sentiment patterns, and at the same time also where the consumer is feeling stretched, especially when it comes to inflation and potential risk of more inflation from the tariffs. What are your thoughts on that?
Yeah, I mean, even before tariffs hit, we have a situation where food prices are up 28% since pre-COVID. So there's a reason why people feel anxious about tariffs coming in on top of that.
I will be back.
Employment, as you note, I mean, this is the thing that needs to hold in. And we are seeing some weakening on the margins.
You
We
are.
saw a large number of employees leave the market, which accounted for sort of the denominator effect in the employment numbers improving. So that's not really a reason why you want to see the unemployment go down. So there are some legitimate, hard data angles to it that are worth taking note of and looking ahead.
I wanted to talk a little bit more about the consumer and some takeaways from this latest earnings season. I know we're gearing up for a new earnings season in a couple of weeks. But one of the patterns that we noticed was you had retail executives talking about the value that consumers were seeking and, opting for a private label when we're talking, for instance, about a Kroger. How much of that shift do you expect to become sticky and potentially a new normal?
100% a new normal. And the reason for that is that we have a consumer that is uniquely empowered for transparency. So this is not like 2008. This is not like prior cycles. Companies are more armed with compute power, and consumers are too. And what value seeking means is different for everybody. So you have names like Costco, where people want to buy in bulk, and that means value seeking. You have a trade down to private label. You have different, different types of substitutions, and likewise you see companies optimizing their supply chains and seeking different routes to market. So value seeking means something different to each company, and that really speaks to management's skill here and how are they going to move on from this long road of high prices that had to overcome this post-COVID period of inflation and deal with these tariffs now.
All right, Sarah, thank you so much. Have a great weekend and a wonderful holiday. We appreciate your time this morning. You got it. That's Sarah Henry, Portfolio Manager at Logan Capital Management. We've got a lot more to come on Trading 360. Next up, it is the Big Three. 3 stocks, 3 charts, and 3 trades. Rick Duquette goes through the technicals, and Jason Brown takes us through his trades. He's got members of the Mag 7 on his list, Amazon, Google Alphabet, and Apple. That's next on Trading 360 here on Schwab Network.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing,
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Diane King Hall. Time now for the Big Three. 3 stocks, 3 charts, and 3 trades. Rick Duquette will take us through the charts, and here to take us through the trades is Jason Brown, founder of thebrownreport.com and author of 5-Year Millionaire. Jason, before we jump to your trades, I'm curious to know your big picture take on this market. We got new records today.
You know, it's not surprising that we have new record highs because we also have no new record drama, whether it's geopolitical or presidential here in the United States. So everything is calm and clear going into the holiday trading weekend. So we'll take it.
I like that. A big smile on your face. We got a lot of the Mag 7 higher, a couple of them facing some chop. Let's talk about your first trade, and you've got a trend here. You've got Amazon on your list. It obviously hasn't been the top performer within the Mag 7. What's your views on this now?
Yeah, so my big picture thought about these 3 stocks is Mag 7 obviously is a popular set of stocks, but these 3 that we're going to talk about, particularly Amazon, they haven't been the outperformers like the Metas, the Nvidia, or the Microsoft, which is up pretty handsomely today. And that's what I like about this. You had a pullback in Amazon. You had some tariff issues that kind of proposed a threat to the company. But with that tailwind behind us, and they have yet to realize what's happening with AI. They haven't really made a big splash or a big, that like, oh, this is the thing that's going to revolutionize the world. However, they're making small incremental changes to their robotics programs, to their cloud services, as well as to their logistics using AI, which I think will bode well for the stock in the long term. And then from a technical analysis standpoint, we've just started a little bit of an uptrend, and then the stock's pulling back using the 20-day moving average as support. And what I like about it is it's not at all-time highs like the Meta, like the Microsoft. So it gives you about 20 to 25 points to the upside comfortably with a reliable name.
Okay, all right. Rick, take us through the chart for Amazon, and then Jason, I'll have you finish out how you're approaching your trade.
Right, as Jason said, a bit of a slowdown recently, and you can see that we had a blue trend line starting with this low point that we had during our tariff news announcements here, but from there, the price action has transitioned more to a more modestly sloping white channel between these two white dashed lines here. As Jason said, this is our 21-day exponential moving average. Not exactly the same as what he said, but pretty close here. Kind of a similar concept, just bouncing off of this supportive indicator. Moving averages would be support during an uptrend, resistance during a downtrend. Not saying it will hold or won't hold or whatever, just this is where price bounced several times recently here. Now, another key price area, 216, our green line, high point here, low point after a small gap, low point, high point, repeated high point. Now we are breaking out above. This would be another area that you might be looking for to the downside for a potential retest here. We've had our breakout. If price were to dip lower and hold that line at our 216 level, which not only is that repeated horizontal level, but also our 21-day EMA once again, and our trend line, that would be an important point to be on the lookout for. A little bit of bearish divergence here so far, but as I said, that doesn't necessarily mean that it's an impending collapse, just that the momentum is slowing down a little bit. It could be gearing up for another upside phase if the bulls can take control once again here. But this gap level here, 236, that's one notable area to the upside to watch. Volume also pretty heavy down near the area where we were just previously discussing, near about 214, 215.
Okay, Jason, tell us a little bit more about your trade strategy here for Amazon.
So here's the trade. I like to go long and use calls to get some exponential growth and control the stock versus owning it. Looking at the June 18th, 2026, 210 strike price. You could probably get into that anywhere between $39 and $40. The break even will be about 250, but what's beautiful is you have over 300 days, about 350 to be exact, at the time of this live stream, and that you got pretty much a whole year to watch this stock hopefully continue to climb up and start to roll out and see the benefits and advantages of AI.
Okay, all right, so that is almost a year. That is a long strategy there. All right, let's talk about the next one on your list. You've got Alphabet Google, another underperformer in the Mag 7. It's got some regulatory risk around it, or regulatory headwinds, I should say, but tell us a little bit more about your views, Jason.
Yeah, so when you look at the Googles, the Amazons, the Microsofts, the Apples, I feel like they always have some regulatory risk around them. Someone's always trying to sue them. Someone's always trying to say they have a monopoly. But when you look at the long game, this stuff takes a long time to play out in court, and the companies usually end up making some type of deal or end up beating the regulatory risk and coming out unscathed, or they make a boatload of money in the meantime and they can pay the fees that typically come up. I like that the stock is in an uptrend and channel. It just recently recrossed the 200-day moving average. It has about a 25 potential points to the upside. And then what I like about Google with respect to AI, I recently upgraded and was testing out their Gemini. I like how they're bundling Gemini, mixing it with your Google Cloud account. So I got 2 terabytes of storage. I think they have a very powerful position to not just provide AI and search, but they can bundle it with all their other Google services, allow you to write better emails, different things like that. And I can also see that boding well with their corporate clients, so how they can just increase revenue by adding kind of a bolt-on service or getting customers to upgrade a service that they already have. And it just ends up being free cash flow for the company. So I like this one.
Okay, so Rick, you're up next. What do you notice in the chart for Alphabet Google?
Big recovery off of those lows that we established here. A similar time frame, once again, for that tariff news announcement time during April. The 140.53 was our 52-week low. Very quickly, though, we broke through this trend line that began back here with our last earnings announcement here, the high point near 193. We haven't really come quite close to that point once again yet, but we have broken the trend line. Now, a much more consistent, longer-term channel than our last chart here. A bit of a wider range as well here, still pointing upward, but a little bit of a slowdown here. We are stopping at this level 181, high point, low point, low points, high point once again here. So you can see this is one of those frequent stopping points for price that really stands out as a potential area to look for resistance here. And that doesn't mean like you're looking for the price action to stop there and it's a brick wall. It would be either a rejection point or a breakout point would be the hope if you had a bullish outlook. From there though, as I said, we have that old high right here on the road to filling that gap. 192.75 would be another area to watch. Moving averages are starting to shift. We can see our faster 21-day overtaking its slower peers here, which are for the most part still clustered together relatively close, which speaks to not really a super clear trend direction, but things do seem to be pushing to the upside. It could change even more if we do get that breakout above that resistance level here. RSI trending down a little bit though. Momentum is slowing here. We have a red trend line in play. Our green upward sloping trend line has been broken here. So that's a bit of a question mark as we head into this holiday weekend today. But also, when we look at our volume profile study here that shows the heavy trading areas, we have managed to clear this relatively large node here near 175. The point of control, 165 down here. That's the heaviest trading area. If we were to break higher, volume picks up once again near like 190.
Okay, Jason, I'll send it back to you. Tell us a little bit more about your strategy here.
Yeah, well, as Rick mentioned, the moving averages are kind of all congested together, but that's when you want to take a look at these stocks before they start to pull away from each other and the trend really takes off. Similar to the last trade, I'm looking at this all the way out into June 18, 2026. I'm looking at the 165 strike price, so you got, again, about 350 days. Now, keep in mind, just because we're going out that far doesn't mean it's going to take that long to materialize and recognize some potential profits, but I like having that time on our side. You're looking at about 3250 for almost a whole year of controlling Google at about a 0.70 delta on the options, and the break even is 197.50. On the upside, again, we can move about 25 points up to about 206, where the stock started to tumble from. So, over 350 days, 25-point moves to the upside, a solid name, and yet to really fully appreciate AI and all the things that they can roll out. I think it's a nice, safe trade. While markets at all-time highs and you're not chasing, you're catching some of these that still have some room to run.
Let's talk about the last one on your list, another former fan favorite within the Mag 7. It's had challenges this year, but the Bulls seem to finally be pushing back on the Bears. Where does it go from here, Jason?
Yeah, so I like a good company that's had some challenges because that means all the good news isn't baked into it yet. And if you look at Apple from a technical standpoint, it started to build a base around 196. And then, they have yet to really innovate from AI. There's no big splash on the phones from AI. There's no real overhaul on Siri from AI just yet. And so we haven't really had a reason for people to just run out and upgrade their phone yet. They still have found the base around the 196 area. And then this is one company that can benefit from a permanent trade deal with China, which was part of the reason why it sold off as well. So I think the future of a trade deal, as well as we're still kind of waiting to see how they're going to capitalize on AI. And I think they're smart. They don't have to rush and just put something out just to say they're in AI. They can wait and see how the users really want to use it and then launch something that's going to have every company and every consumer upgrading their phones, their laptops, their iPads, and then we can see a major trajectory upside. And maybe there may be some AI services that they roll out that can get you to increase their monthly service revenue, which is really how Apple is raking in a lot of their cash right now.
I remember on one of the earnings calls a couple of years ago, Tim Cook kept making the point, we've already been in AI. I'm paraphrasing how he said it. But I think the way investors have viewed it was they weren't telling us enough or telling the street enough. So that's been one of the challenges for Apple because they've been like, we've been here already. We've already been doing generative AI. But, the view has been, what have you done for us lately? Rick, Jason just mentioned some levels that he's paying attention to. What are you noticing about the chart?
Yeah, 196, that's the very level that I have marked on my chart. The reason is because it represented a significant low point from all the way back there. Once again, our tariff news cycle comes back into prominence, but this was kind of a price shock moment. And after the markets had a couple weeks to kind of digest this information, the 196 level, in terms of closing prices at least, held firm several more times. So depending on how you look at it, you could do horizontal levels, or you could do this more symmetrical triangle type shape where we have a downward sloping trend line going across the highs and an accompanying one going across those intraday low points here. Either way though, 196 was a key level. Price is pushing to the upside. We are breaking above our moving averages, all three of them in a very quick succession over the past 4 or 5 sessions here or so. For now, hanging out above the purple 252 day at 213. And to also kind of piggyback on what Jason said before, the moving averages can show signs of potential trend change, and as technicians, you would want to be in on the new trend as early as possible here. The question is, when do you decide that has confirmed here? So one method people use is closes above these moving averages and the slope's starting to turn. That's what we're starting to see here. That doesn't mean that it couldn't be prone to a fake out or some kind of reversal here. If it does continue though, 225, a series of highs right there stand out as another possible area to watch to the upside here. Notice as well, RSI breaking out of a longer term downward sloping trend line in red there, approaching the overbought area actually, which would be usually viewed as a sign of strength in a trending market. So now, if we were to look at our other studies here, we can see that area 225, that's where we start getting into the heavy volume again. That's our +1 standard deviation channel at about 226. That's our volume profile point of control near about 229. So another key area to the upside if we were to break down and move lower once again. Big volume node here near 200. We've got our 21-day EMA near about 204 as well.
All right, Jason, 225 area to watch to the upside that Rick just mentioned. Tell us just a little bit more about this trade.
Yeah, and so there's levels of resistance. 225 is one. If you look at the all-time high, you're looking at the stock getting back to around the 260 level. So that's about 45 to 50 points from where it's at right now. And again, you're picking up a Mag 7 stock that is not an outperformer, so it still has room to run in this market where we're sitting at all-time highs. And from a trade standpoint, I like going out to the 195 strike price, June 18th, 2026. So again, I've been sending all three of these all the way out to next year. So you got a ton of time. Again, doesn't mean we have to wait that long for it to materialize and recognize some profit, but it's not something you got to sit in front of your computer, in front of your desk and watch all day, every day and panic about the option expiring. It's going to cost you about $37 to control one of the biggest cash heavy and device heavy in people's hands company all the way out to next year. Your break evens at 232. I love the potential upside combined with the time and the fact that it's not trading at all-time highs yet. If these three stocks can break out like the Microsofts, like the Nvidias, we can catch that range up to resistance and possibly start to get the cup and handle as they trend past it. And we got a whole year to see how this can play out.
Okay, there's time on your side. That's Jason Brown of thebrownreport.com and our very own Rick Educator. Thank you both. Have a great holiday weekend, guys. Coming up next, we're going to spotlight the defense sector, European defense stocks in particular, as U.S. and NATO policy changes bolster the industry this year. We'll have insight on the other side of this break. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Trade 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight the defense sector, in particular European defense stocks. Joining us now for insight is Peter Anderson, Chief Investment Officer and founder of Anderson Capital Management. Peter, thank you so much for joining us this Thursday. You see, I'm so used to Jobs Friday, but it's a holiday short week, Peter. All right, so let's talk about the defense sector. We've been paying attention to that. One of the things I've noticed, for instance, on the U.S. side is RTX has been an outperformer compared to the S&P 500. Boeing, to some degree, is obviously some defense exposure there, outperforming compared to the S&P 500 this year. You've been leaning into the defense sector, in particular European defense investments. Tell us about what sparked that. What's been the catalyst for you?
Well, honestly, NATO spending just woke up. You know, it's been in a dormant phase for many years, and with the advent of the Trump administration, all eyes now are on NATO spending and estimating how much more they will have to invest to now protect themselves. And frankly, it was a trade that nobody talked about for a long time until now. It's finally getting a large focus on smart investors, and I think it's the right time to look at European defense stocks. There's a number of reasons why.
Okay, so there's a number of reasons why. What else do you see besides what we're hearing from, it's loud here on the floor, excuse that, from the plan by the Trump administration?
Sure. So it's a combination of many things. Of course, it's the Trump administration and reigniting the debate about should the United States be investing in NATO, but it's also other things. So global warlike behavior is more on the increase. That's the first thing, especially in Europe, right? And we also know that Russia has increased its spending on defense. And then we've also seen just general uncertainty about who is going to team with whom if there is another conflict, especially in the European theater. So all this adds up to Europe saying to themselves, we can no longer rely on U.S. Backing us as we historically have, so we've got to be big boys and girls and grow up on our own and start cashing out and spending some money. And as we know, they recently announced, which was tremendous for the sector, they recently announced, I think it was late last week, that they're intending to
pull back and hit the 63
spending as a percentage of GDP, 2.5% all the way up to 5%. And this was unanimous, frankly unanimous, except for Spain.
Peter, you make a great point about a lot of focus now on the defense sector. Goldman put out a note at the beginning of this week looking at European defense.
Jake Paul.
One of the things they pointed out is the underinvestment that's had been occurring there for decades. Is that one of the things that you're pointing to and paying attention to and expect to see increased investment?
Oh, absolutely. I mean, in our opinion, we're predicting a global pivot to the shift from focus on U.S. defense companies to European defense companies, because now
you sure about that
we've been talking about is quite public. And so even though it was a trade nobody talked about, say, 2 months ago, it is suddenly getting more attention. And of course, I think the accelerant for that attention was the recent NATO announcement that they're going to be doubling their spending. I think that caught a lot of people that have not been looking at this sector by surprise. And so I wouldn't be surprised if we really saw a doubling down on the exposure to those stocks by many asset allocators and managers.
Where do you expect to continue to see outperformance? When you think about where we are, we're already halfway through the year. You've already seen some outperformance. Where do you see that continuing in the defense sector?
Well, we own a basket of European stocks that we purchased early in the year, so I will name some that we think are very attractive and remain attractive for at least, in our thoughts, about another 12 months to 24 months. And those would be Airbus, BAE, and Rolls-Royce. Rolls-Royce because it has the drama of being a turnaround. We love turnaround companies anyway, and so the fact that it is a turnaround in a sector that we're enthusiastic about is a double hit for us.
When What are you paying attention to? So obviously you point out some tailwinds, which I can see the argument there. But to play devil's advocate, for lack of a better way of expressing it, what's the other side? What's the risk that you have to pay attention to for the potential for this outperformance to run into a stumbling block?
Sure. Whenever we invest in a stock, we also have sell triggers because that's extremely important. Not necessarily on the price of the stock, but the performances of the company or the macro environment they're embedded in. So the most drastic situation would be, and we think that this has very low probability, would be if NATO reversed its statement and said, we don't know what we were smoking at the time, but we're not going to be investing 5%. We're actually rolling it back to 2.5%. I don't think that that's likely. And then the second thing that could star this thesis would be if the U.S. decided to suddenly turn around its policy and decide that it has second thoughts and it's coming back and it will actually reinforce the NATO investments. We don't think that that's likely either. So those are the two main issues. But in terms of looking at those companies, they're extremely well-run companies. They have products that span the entire segment of defense, either on a defense position or an aggressive armament position. So we think that those are the only highlights that could make this thing go the other way.
And then, Peter, I want to ask you one more thought, because one of the things we've been paying attention to, and just hear me out here, is trade policy and how there could potentially be a shift in relationships and what countries have better relationships, for instance, with the U.S. When you think about that in terms of defense, right? Do you expect to see a kind of a reshaping of relationships, especially with the advent of autonomy and AI and who will have the best partnerships? What are you expecting in terms of that?
Yes. It is indeed a moving target, and you've conflated two things that are very difficult to analyze on their own. First, the trade policies, right? I mean, that is a wild card. We really haven't settled down to a clear visibility with a compass that tells us exactly where we're going with the trade policy. So that's difficult to predict. And then add on to that what you're suggesting, which are the possible relationships between these countries. And it's extremely complex. I will say this, though, that we saw some very good vibes from the NATO meeting. If you recall, the leader of the chair of that group was actually praising the U.S. administration for encouraging it to invest 5% of its GDP. So that on its own is remarkable. Do I think that could sour? Anything can happen. You have to invest with the sense of risk probabilities, but I do think at this point, at least in the relationships, not the trade aspect, but the relationships I think are pretty much set for a while, and I think we can be fairly confident that there aren't going to be any anomalies in that. But the trade issue is kind of a wild card in our opinion.
That's fair. Peter, great conversation. Thank you so much for joining us here on a holiday shortened week. Have a great holiday weekend.
Thank you.
It's Peter Anderson. You got it. Peter Anderson, Chief Investment Officer and founder of Anderson Capital Management. Coming up next, the disruptors will highlight Roku following price target hike and how one analyst believes there could be upside to the streaming stocks 2025 outlook. Trading 360 will be back after this break.
Roku.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options,
Technical analysis and being in the now.
Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Count me out. I don't have time. Nike had a little good run yesterday. Yes, it did. Oh, it's had a good run all week.
Hey, Dad. I have a question for you.
How come Grandpa doesn't sleep with me anymore?
Granddad had an account with Schwab before there were.
How come Grandpa doesn't sleep with me anymore, Daddy?
She was with me, with the journal.
Jim, you're sick.
The two grandchildren are planning for their college educations. Someday it'll be their turn.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Trading 360. I'm Diane King Hall, live from the New York Stock Exchange. Time now for the Disruptors. Joining us for Perspective, George Sillis, senior markets correspondent here with today's company. That is Roku. Shares are trading higher today. Not as big as that jump we saw recently off the back of that Amazon news. But what's the latest here fueling this game, George?
Well, yeah, I think, Diane, I mean, looking at Roku, the financials are starting to look quite constructive, and I think that's the bottom line view that Bank of America has of their upgrade today. They actually moved their price target on the name to basically $110 from $100. They actually see some constructive gains in EBITDA on a forward basis. This analyst actually has about a $350 million expected EBITDA in the next fiscal year. And in fact, if you look at last year, the company actually lost about $148 million. So the company's turnaround in terms of its profitability profile is, I think, what is interesting here for Roku. Obviously, the Amazon partnership was a big deal for them. It basically adds, advertising, video on demand revenues. Roku's becoming one of the larger connected TV platforms, with over 80 million active subscribers on a per month basis. And I think the aspects of the improving EBITDA conditions are quite compelling for Roku, because this is a company. It's been around for quite some time, but the challenge has been profitability. And looking at the forward 4 quarters, actually moving into the fiscal year 2026, it looks like they're expected to be fully year profitable on an adjusted basis. So for what it's worth, that does speak to strong trends in an underlying product and, of course, market that is actually improving both on a connected TV ads basis, but also rather than competing with Amazon, they decided to partner up with them, and that's also quite compelling as well.
Okay, so now, given what we're seeing today, the price action today, and then, some of the momentum recently, how do you go about an example trade for this one?
Yeah, so
George.
In this case, because we're going to have a short day today, and tomorrow is basically a holiday. I'm actually going to capitalize on this bullish trend. But I'm also going to harvest some additional time decay and an option premium by selling it, so we can again get a couple of extra days of pre-theta decay or a premium. If you look at the trend since the April lows, it's been trending both above the 10 and 20-day moving average. I do think that it's possible that the markets pull back anytime soon, just based on some consolidation and short-term pullback, and the stock itself, Roku, now may pull back that 20-day moving average, which is around $80. So what I'm going to do in this case is I'm going to sell the August monthly $85.
Tesla got a little under 320.
Put, you basically are getting paid about $5.
319.33.
You essentially are taking an implied ownership of the stock if it does hit 85 or lower by expiration. But if you take that premium away from that $85, your break-even price, if you're assigned the shares at 85, is $79.50.
319.22.
Looking at the math, you're selling in this case that 85,
another buck,
which is around a 36 delta, implies a 64% probability of profits. And lastly, that premium of $5.50 relative to the strike is around $7. Yield to strike price.
George.
Yield to strike price. So what that means is, if the stock holds the $85 or higher, yield to that strike price is around 7%, which is quite good in the next 43 days.
Okay, yeah, you make a great point. This is a holiday shortened trading day. We only have a little bit more than an hour left in the trading day. That's George Sillis,
oh, really?
Correspondent. Thank you, George.
We have a short day today?
Time for our 360 round. We'll bring in our panel to cover this morning's labor market data, how Fed might interpret it moving forward. We've got insight next on Trading 360.
After this is done, I guess I'm going to continue with napping.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a... Carl's Way is the best way.
It is the best way.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Do, 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 do. You were pumping what, Microsoft yesterday? Do, do, do.
Welcome back to Trading 360. Time now for our 360 round. For that, I want to bring in our panel to discuss today's better than expected jobs report. Joining us now, we have Olu,
Better than expected.
Chief Economist at Huntington Private Bank, and Amy
Damn.
Fraser, Senior Vice President at Adeco. Olu, thank you both first for joining us. Olu, I want to get your thoughts first on today's jobs report. Better than expected on the headlines number.
It sucks.
Job growth of 147,000 for June. Unemployment rate at 4.1%. What was your initial reaction? Were you surprised at all?
I went into shock.
Thanks for having me, Diane. It was a very good report. The headline number was stronger than expected. There were some negatives, but the positives outweighed the negatives. We also saw positive revisions to job growth in April and May. We saw a decline in the unemployment rates. The unemployment rate went down to 4.1%. So overall, this just really shows that it is a good U.S. labor market. Again, there were some negatives. The job gains were concentrated in a few sectors. So the government and healthcare sectors drove the job gains in June. And this has really been a trend, over the past couple of years. And it's just signs of some cracks in the labor market. But overall, it's a good labor market. The unemployment rate is low. Average job gains over the past 12 months is at around 150,000, another sign of a good labor market. And we think, this really buys the Fed more time to continue to assess the U.S. economy and wait to see the impacts of tariffs, fiscal policy, deregulation, and so on over the next couple of months.
Just put a pin in that for a second because I'm going to come back to you for further thoughts on the things that you find challenging within the report. Amy, I'm curious to know your thoughts on the state of the labor market. How would you characterize the health of the labor market right now?
Very good.
And I'm very bullish coming in today, and I think this report reflects what we're seeing on the ground. The American workforce has continued to be remarkably resilient and adaptable.
Okay, all right. Olu, I want to go back to your thoughts about, some of the points under the hood where there were, we'll call it challenging data points. One of the things that stood out to me was the number of people working part-time for economic reasons. That seems high. I mean, it's changed little over the month, but it still seems high, relatively high. And then I'm curious to know your thoughts when we look at private sector payroll. So within the report, private payrolls did grow 74,000. That was weaker than expected, though. And by the way, we got the ADP report. We know there's divergence now between the two numbers, not like it used to be many years ago where they correlated.
31,
now,
31,
right?
63, 31, 25.
What does the private sector payrolls numbers, what do they indicate to you?
Yep, Diane, to your point, there's been weak correlation between ADP data and the BLS data for a while now. I think the weakness in private payrolls just really points to just a moderating labor market. The labor market isn't as strong as it was last year. So job gains in the private sector, in June were about 74,000. That was the weakest since late 2024. Usually, ideally, you would like to see job gains across the labor market, so in manufacturing, construction, financial services. That hasn't been the case over the past couple of years. And in our view, we think that we're going to see just softer labor market activity through the second half of this year.
Yep.
We think that restrictive monetary policy, tariff policy uncertainty, we think that, that those will, lead to slower growth in payrolls over the second half of 2025.
And then Amy, where are you seeing, I know you all, Educator has a lot of insight into where there's strength in hiring. What sectors are you seeing strength in hiring?
Healthcare continues to be white hot, and it will continue on into the future with the aging workforce. So healthcare is hot. Hospitality has been great. Rebounding from COVID continues. And believe it or not, I know we're only in July, but companies are looking forward to the holiday season and really starting to get a grasp on holiday hiring as well.
Interesting to hear that now, and right in front of the, Christmas and summer Prime Day events, which is, kind of the preview to the holidays, in my opinion. So, okay, that's a little bit of a tangent. Olu, I want to get your thoughts. You kind of indicated them now where you think this leaves the Fed. When I look at the CME Fed Watch tool, July's off the table, essentially, even though the calls are loud for a cut in July. Where do you think this leaves the Fed on when a cut could happen?
Yeah, look, the calls are allowed for July just due to backward-looking data. Q1 GDP contracted 0.5%. We actually saw negative revisions to Q1 GDP when that came out. Obviously, we have seen a moderation in the labor market. Job gains have slowed. Job gains are concentrated in a few sectors. We've seen an increase in initial claims. We've also seen an increase in continuing claims this year. But the Fed is more concerned about the impacts of tariffs on the U.S. economy, and the Fed hasn't quite seen any significant impacts yet. So we think the Fed will continue to take a wait-and-see approach. Now, the great news is that inflation has been trending lower this year. Several measures of inflation, CPI, PCE, those have been trending lower in 2025. But the Fed still expects that we will see impacts of tariffs in the second half of 2025. So we're calling for the Fed to cut the Fed's funds rate by 25 basis points twice in the second half of 2025. We think it's very unlikely that there's a rate cut in July. We think September is more likely at this point. We're expecting to see just softer labor market conditions. And we think that will put the Fed in a position to cut rates, and most likely in September.
Okay, all right. Thank you so much for your perspective. That's Olu Omodunbi, Chief Economist at Huntington Private Bank, and Amy Glazer, Senior Vice President at Educator. Thank you both. Have a great holiday weekend. Thank you for joining us on Trading 360. Download the free Schwab Network app. It's available in the Apple App Store. And tune in 24/7 on schwabnetwork.com. I'm Diane King Hall. We've still been watching records on Wall Street. Stay with us. You've got Fast Market up next.
Very interesting.
Schwab Bank Investor Checking the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Right, Diane.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Amazon had its run today. Mr. 20-day high on Mr. Right now it's at a pivot point. This is kind of interesting. Google.
Good afternoon, traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today. We're going to talk markets, which are hitting more record highs, and then we'll look at some option strategies. We're going to cover Amazon. It's relatively flat this year ahead of next week's
Jimmy was just looking at it.
It's not Prime Day, it's Prime Days. And Oracle, which is at record highs today after expanding their partnership with Stargate and OpenAI. And then like Folio will have consumer sentiment data in Starbucks, which is up over 20% from its April lows amid its turnaround story. Now let's take a look at the major indices, which are at session highs as we speak. The benchmark S&P 500 up over 0.8%.
Means that you can be buying Disney.
Up about 350 points or 0.8%. NASDAQ 100 up over 1%, hitting new record highs, and the Russell 2000 small caps up 0.8%. Outperformance for the Russell so far this week. To help me break down all this market action, let's bring in my co-host for the day. That's going to be Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nate, happy Thursday, Synthetic Friday, and the markets are in a good mood today, and maybe they should be.
Yeah, they are.
Yeah, no doubt, Tom. I mean, this market is so, just momentum driven. It reminds me a little bit of last summer in July. Or if you want to go back to 2021, this is a tech-driven market. I mean, this is where the earnings growth has come from. There's all of these announcements around investments and AI and power, etc. And so, you know, I think that there's a lot of, are we getting complacent is a little bit worrisome. We got an RSI of 75, almost 76 on the S&P 500. For reference, you know, for our viewers, just go pull up a historical RSI on the S&P 500 over the past, let's just go 5 years, and just notice that it doesn't spend a lot of time above 75 before getting some kind of a pullback. Last summer, we had that the scare of the unwind of the carry trade, and we actually hit an 81 on the RSI.
Yeah.
We got a little bit of volatility. We got some pullback, and the RSI pulled back to its next previous peak of 76, while the S&P was making new highs. So we had a negative RSI divergence. That would be one thing to look for. And then, of course, the back half of July, we rolled over, and then it got exacerbated by the unwind of the yen carry trade. If you look at, well, how high
I forgot about that one.
The S&P 500 over the past 5 years, we've been at that 81, 82 level basically 3 times. Once last year, once in December of 2023, and then once back in September of 2020. When we hit that 82 RSI in September of 2020, we got a 10% pullback on no news. So the point I'm making is, guys, look, next week, Tom, you know this, we got the July 9th date. We heard about the Vietnam, trade framework deal that was there. The market at new all-time highs, in my view, is basically saying tariffs are not a problem. They're not going to impact the economy. They're not going to be inflationary. The Fed's still on our side. So there's like no, risk premium, so to speak, to put into play. No discount for the potential for these tariffs to have some kind of an impact. So Vietnam, for example, it's not 10%, but it's 20%. That's less than the 46% in April. But what if there's a threshold for corporations where at 10% they're willing to take those costs and eat them and not pass it on to the consumer, but at 20%, maybe now we start to see some of that inflation in the coming months filter into the system. So, Tom, I guess, look, the economy is very resilient. It's as evidenced by the JOLTS and the non-farm payrolls data that we saw this morning. The AI secular growth story is intact, and it's exciting, and there's a flurry of that type of investment. Also, Web 3.0, tokenization, etc. That's also creating a lot of the buzz, a lot of the momentum. The dip buyers have been rewarded. If you're chasing the market, you're essentially getting rewarded, but don't get complacent. The VIX is at 16. If you want protection, now could be a good time. I can't give you a recommendation, but you could marry a put on some of your long positions so you can have a little bit of comfort there. You could sell calls. You could buy VIX calls. There's so many ways to utilize options to at least hedge some of the exposure without
getting
too
kinky.
Caught up in the momentum.
Marry a put.
Because, Tom, it could be as soon as next week when we're going to hear from the likes, I would think, around the EU, Japan, and potentially maybe not China, not yet. So I'll say the EU and Japan, but we're going to learn more about where these tariff rates stand. The market is saying no big deal, but it could end up having some implications for the U.S. economy.
Boy, Nate, you're putting a wet blanket on this big giant rally that we've had.
Hey,
you bring up some good points. The protection's cheap right now. You got the VIX at 16. There's still some headwinds out there overhanging the markets, but you kind of labeled all the good things that are going on in the markets right now. We're getting wins across the board, whether it's data, whether it's potentially getting that tax bill through sometime today. If Hakeem Jeffries stops talking, maybe they can vote on it. But, and here's the thing, these eyes have seen a lot in the markets, and protection's cheap, but maybe protection's cheap because it should be at this point, Nate, because it seems like the market's kind of ignoring anything that might pull back or maybe stunt the growth that we're seeing. But at the same time, if you look at the jobs data today, is a perfect example. 147,000 jobs added, above the expectations of about 110,000, right? That was, but the unemployment rate goes down to 4.1%. That's good news. Full employment. And we're in that predicament now, Nate, where people are saying, oh, we need to cut rates. We need to cut rates in July. Well, the market's, telling you that we don't need to cut rates in July, that we're handling everything okay. And the wealth effect's coming into play with the market at all-time highs. And if the market or the data starts to crack a little bit, or the economy starts to crack a little bit, you got the Fed there saying, hey, now we'll cut rates, and that's also good for equities. So it's almost that dynamic where I understand that relative strength index, the RSI is above 75, and typically it doesn't stay up there for very long. But at the same time, it just feels like the momentum in the market right now has crushed bears over the last couple of months, and it might continue to do that until, I think there's one other catalyst out there, earnings season that starts in a couple weeks, Nate.
Yeah, no doubt. And look, Tom, that VIX at 16, market at all-time highs. Nobody wants protection. Right. Nobody cares. Nobody wants to hear this, right? They want to buy it when the VIX is at 30 and 40 back in April. It's just the way the market is, and I get it. I'm just saying, look, as a consideration, 16 is basically the low on the VIX. Also, I'll point out, potentially a negative, and I'm not trying to be negative. I just have to kind of balance some of this out because I know we have a lot of viewers that are participating in this momentum-led market, and it's great. We love to see green on the screen. Everybody loves to make money, but Atlanta Fed GDP downgraded from 2.9% to 2.5%. This was about 3.7% a couple of weeks ago. Just something to keep in mind. And look, I think that you have to respect, to your point, Tom, that the market can continue to go higher longer than than makes sense. It can be irrational in that sense, and you have to respect that there are no rules, there are no guarantees, there's no bell that rings. Even if we go to an 82 RSI, that doesn't even though historically that's where it peaked out before we got some kind of a pullback, that doesn't guarantee anything either. So you respect the momentum, you respect the price action, but Tom, if we're not going to use the RSI or some of these types of indicators, what are we going to use to get a sense as traders?
It's a very good question.
Look for some kind of pullback. So RSI is just one thing. I would also look for this for our viewers out there in the near term. If you're looking for indications we might get some kind of a pullback, you want to look for selling on good news, or you want to look for some of those near-term reversal type patterns. So that could come in the form of a shooting star, or you can get a gravestone doji, or you can get a dark cloud cover where you gap up and then you sell off to the previous day's candle. Go look up bearish reversal patterns. We don't have them on the charts right now, but at least that's something that you can at least have on the dashboard so that you're at least aware, so it doesn't because when we move up this quick with this kind of velocity, those snapback corrections, those profit-taking consolidation moves can also be swift.
Yeah, you bring up great points here, Nate, because of the fact that, you've got to protect maybe portfolios, positions when you can, maybe not when you have to. And I think that's what it's kind of coming into play here. And then also you start thinking about short covering. How long is that going to last? Because I know there's shorts out there, because a lot of people don't believe in this rally. Nate, and that's one of the things we talked about this week is this is, to me, one of the most underloved rallies that I've seen. This is the fastest snapback rally that we've seen from bear market territory in April to here since I believe about 1950. So, these are events that are happening in the markets that kind of make you scratch your head when you see the S&P 500
close at 1
PE above 22.
That is correct.
Hey, can this last, or will the growth continue?
49 minutes left.
Where we're going to have some type of balance, but I kind of agree with you. We might need some consolidation at least at these levels, with about 77-78% of the S&P 500 companies at or above the 50-day moving average, simple moving
62.85.
Tracking type of technicals when I start thinking that maybe the market's overbought here a little bit. But to go back to the data, we had the jobs data, which was better than expected, and then you have the services numbers that came in better than expected from the ISM. Does that kind of relate, Nate, where maybe we could get into a little bit of expansion here throughout the summer? Because remember, over the last 10 Julys, markets shoot typically up. The S&P 500 is up on average about 3.3%. So we're getting into that that area in the market where it's summertime trading, there's not a lot of data, there's not a lot of news over the next couple weeks, where this can get extended to those RSI levels that you talked about. And, you know, maybe there's investors out there that want to continue to ride this wave because stocks are forward-looking, Nate. Are we going to be higher at the end of the year? Is the economy going to be better at the end of the year? And I think a lot of people are predicting that it's going to be.
Right. And, you know, if you look at, you know, yes, and a lot of the big banks continue to kind of bump up their year-end S&P price target. But, you know, that's, of course, they're doing that because the market's moving higher. This is just kind of a reactionary move. And to your point about this not being a loved rally, it does feel kind of like the pandemic when we had that big sell-off back in April. And then Fed came in, we got the stimulus, etc. But during the months of May and June and July, just a lot of doubt, a lot of pessimism, a lot of skepticism, you know, don't buy into this rally. July, August, that's when we got up to the 82 on the, when we got to like September 2nd in 2020. Go look at the chart from March to September, and this market just plowed.
We're trying to get across.
We had day trader stocks only go up. It has that kind of momentum. And so, yes, it can go on. Seasonality, when we start getting near August, I think you got to be a little bit cautious. Financials, all-time highs, they're going to have, because of that setup, going into earnings, which we're going to get in a couple of weeks, we could just get a sell on the news just because they've gone up so much. So you want to be cognizant of that. But August, September, that seasonality is not good. You want to be mindful of that. Mega cap tech, they're going to be reporting at towards the end of July. They sometimes sell off on news. It's not a great quarter, and not in terms of the results, but the price action following these earnings reports. So there's the potential for that sell on the news. But look, the economy does look very resilient. The wealth effect with the stock market doing what it's doing, that's great for the consumer. The job data, what we've seen out of JOLTS and non-farm payrolls conveying we have a healthy job market that's out there. Wage growth, 3.7% year over year. You know, that's good to see. Inflation, so far, it's been held in check. But, you know, yeah, Tom, it's just one of these markets where you just, from a trading perspective, near term, you know, it can do a lot in terms of moving higher. And you have
I wanted to do a lot.
Action, but at the end of the day, when you're buying these stocks, if you're doing it for long term, you know, you have to look at valuation. And I know the market doesn't care about valuation right now, whether we're talking about the AI growth complex or we're talking about the forward PE of 22 on the S&P 500. I think that 22 is there because of AI, because of all these tech green shoots that are going on right now. So you can say, hey, that's justified. I get it. But we'll have to wait and see. I think just the biggest potential to catch the market off guard when we get mesmerized, hypnotized into this uptrend is going to be the tariffs and the potential impact there. I think Chairman Powell is conveying that same message. We saw the July rate cut go from 25% yesterday.
Okay, we're pulling back to the 63 here.
We may not be getting as many rate cuts as we expect from the Fed, and it feels like the market is saying with this kind of price action that the Fed is on our side and rate cuts
62.85 is at 155.
Yeah, it seems like I always look at it this way, Nate, because we try to give, you know, some information to traders and investors at this point. The risks right now aren't for the, in my opinion, aren't for, you know, S&P 500 to rally another 5% this month. I think the risks are out there just due to these overbought conditions to the downside right now, and protection's not a bad idea. Is that something that investors should heed at this point? You know, you don't have to hedge your complete portfolio. You don't have to sell out of your holdings at this point, but you should be cautious at this time because we are getting stretched.
Yeah, no doubt. And like I was mentioning earlier with this kind of situation, because the VIX is so low, you could buy a put. You know, I'm just talking about, Tom, near term. We're going next week. July 9th is next Wednesday. And the market is basically saying, yeah, we don't care. It's not only that, it's as if any trade deal is going to be more clarity, and therefore it's actually bullish for stocks. So it's kind of like irrespective of whatever the tariff rates are. And near term, yeah, whether it's 20, 25%, 15%, yeah, we're probably not going to see it show up in the data. But when we get a couple months out, potentially that can happen. So if we get some surprises, though, what if Japan or the EU, does not want to negotiate, does not want to agree on 20% tariffs, or they're not able to, come to terms, and then President Trump ends up raising the tariffs again. This could happen next week. It's a potential. I don't know what the percentage is, but if that were to occur, that could be enough to get one of those corrections. So what can you do? You could, marry put, buy a protected put against a long position. You could swap your long stock for a short-term call, a couple-week call, or some kind of a call spread. You could buy, like I was saying, the VIX call spread, something like that. Or you could just reduce some exposure. You could sell a call, just hedge around the position a little bit. And again, guys, I'm not giving a recommendation, but I just feel like given the setup, given this monster rally that we've seen, given the 75, 76 RSI, maybe it's a time to consider, some of these types of hedging potentials.
Oh, speaking like a true trader. I love that, Nate. But hey, great advice, and great, just observations of what's going on in the overall market. All right, Nate, let's take a quick break here. When we come back, we're going to take a look at Amazon, the e-commerce and cloud stock. Is only up about 1% so far this year. It's still about 8% below its all-time highs, but it's made some nice gains since those April lows. Stick around, coming right back.
It's like some nice setups right now. See, there was one right there I missed out. 150 to 170, 175. Just recognize it and say, it kind of looks nice. Alrighty. Any questions?
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you.
That's 145, 150
Our
again.
active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best
And
of
being
all,
with it now.
you can ask questions by chatting directly with an education coach. It's interactive learning at its finest.
You might even get to speak to Washboardjim.
Head over to schwab.com/coaching and start learning today.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Nothing's for free.
Welcome back to Fast Market here on the Schwab Network. We're talking Amazon. Shares are up just slightly so far this year. Still about 20 bucks off its all-time highs that we saw in February. Nate, when you look at this company, the silos of revenue generation that they have between AWS, the e-commerce side of the business, and then you start looking at advertising. That's growing at a 20% year-over-year clip at this point. It almost feels like, even if maybe one of the segments of their business isn't doing as great as the others, it's still
too true to be true
from the other sides of their businesses, right?
Yeah, certainly. I mean, just a tech conglomerate. I mean, so many, it's kind of similar to an Alphabet, but, just a well-run company with just such an embedded ecosystem in the global economy. The technicals look good. It's just in a steady uptrend. This isn't a stock that, it's not gonna be one of those higher beta stocks. It tends to be just basically grinding higher. Basically the highest level since February, all-time high up there, I believe, was around 242. You look at valuation, it's 35 PE, which isn't bad. I think they're expected to grow roughly, around half of that next year, so about a 2 peg, which isn't necessarily bad or good. Maybe it's a little bit rich, but there's always some premium there for a company like Amazon because it's so well run. And if you look at the data around cloud and AI, look at Oracle's earnings, etc. There's just a lot of potential to have more than 17% growth going forward. One would think. To your point, Tom, digital advertising looks really good and well. So what's the bearish case for this? Tariffs and trade policy, like the company said last quarter, that potentially now. They reported back on May 1st, Tom. That is like another world that we were living in terms of what the market, how the market felt. So maybe their view on trade and tariffs in terms of that potentially hitting operating profits here, which was their guidance was a little bit below estimates. Maybe that changes, but if these tariffs, which were 10%, which was known, on May 1st, Amazon knew there was 10%. We knew there was a 90-day window. We're going to learn more about what those rates are coming up next week. And then they don't report until early August here, but that would be the one thing that would be the question mark, because there's so much commerce that runs through this behemoth and internationally, and therefore has the potential for somebody to getting hit with those margins should the tariffs be higher than expected.
Yeah, there's an interview with the CEO, Jassy. He's basically saying that they haven't seen any appreciative price increases across their e-commerce platform yet. They've got Prime Days next week, the 8th through the 11th. They've actually doubled it from 2 days to 4 days, basically, in essence. And JP Morgan put out a note, I believe it was yesterday. They expect 10% increase year over year on those sales. So there could be some catalysts next week with not only the Prime Days, but also from the tariff deals. If there's any, any confirmation on any further trade deals or any disruption in potential trade deals moving forward. But you got an example trade for us, Nate, here. Walk us through it.
Yeah, no doubt. And you're right, Tom. It's funny. You've got the Prime Day basically landing right in the middle of that July 9th window. Yeah. So that's interesting to note. But generally, historically, the Prime Day is viewed as something that is relatively positive for the stock. You mentioned 10% growth. That doesn't surprise me. Consumers probably feeling pretty good with stocks at all-time highs. But look, as I mentioned with the RSI on the S&P 500, what you have to be worried about, I think, in terms of whatever bullish strategy you're considering right now, is that you have to respect where the overbought nature of the indices are, and that if we get a pullback in the ocean, then perhaps that could take your stock that you're looking at down. That could be the case with Amazon. Not that there's going to be any kind of bearish rollover, but just some consolidation, some digestion. So with that in mind, and knowing that we have a 3-day weekend here, so time decays an issue, I was looking at a relatively neutral, you could call it bullish strategy, going to the July 25th expiration. I kind of want to avoid any earnings plays right here, right now, and then seasonality when you get towards the end of July into August can be have a shift there towards
kind of squeezing again.
Here's a credit put spread, a bull put spread. I'm just basically selling in this example trade that 215 put, and I'm buying the 210 for protection, $5 width, $1.20 credit. So with a strategy like this, should you get a pullback, you have some buffer between the
And
current
watch
price
this.
at 222 down to 215. If you look at the 20-day simple moving average, it's around 215. When you're in an uptrend, that 20 SMA can be a place where you get a check back to on that uptrend. So that makes sense from a technical perspective. But Tom, this isn't a very aggressive trade. It's because of the overbought nature of the market. Saying I'm constructive or neutral to bullish on Amazon. This would be an option strategy that takes advantage of time decay, and you hope that next week won't be too volatile.
Yeah, let's
There she
break this
goes.
one down. July 25th, a weekly option. So 22 days to expiration, about 3 weeks. Get the long weekend coming up here, so it's positive time decay.
62.85.
So you want it to go to zero. That's the idea on this position. But selling the 215 put, buy the 210 strike put, short $5 wide, neutral to bullish put vertical, collecting roughly about $1.20 credit. Might be about a dime lower than that right now. But if you collect that $1.20 credit, that's what you can make, $120 per spread, but it takes your break even down to $213.80 to the downside. So basically about $10 below the current share price in there. So you have that cushion to the downside. Probability of that short 215 strike that you sell in this strategy of finishing out of the money is about 70%. So those are the trade-offs that we always talk about. You've got $360 or $380 in risk on this trade to make only 120, but you've got better probabilities in your favor that it's going to remain above that short strike over the next 3 weeks. I think that's one of the things. And Nate, this is one of those strategies when you look at it, it's like, yeah, I think a lot of people feel like they've missed the rally. Maybe they're still bullish on Amazon. They're going to wait for a pullback that might not come. And this is a strategy that potentially takes advantage of that, right?
Yeah, so you're right. So you're short that 215 in the event that Amazon does close between 210 and 215. You're subject to assignment at that expiration date of July 25th. And I know, Tom, it's kind of like in this type of market, you're getting rewarded for chasing. Nate, why not put on, a call or a bull call spread or get a little more aggressive or a, call diagonal? And it's because of, timing is everything. And you have to consider, is this the place that I want to bull up on a lot of these tech stocks that have been doing so well? Or should I, kind of take a step back, cool my jets, I can collect some credit. If Amazon moves sideways, that's good for me.
Yeah.
And $1.20 may not seem like much, but if you're considering that you have $5 at risk there and $1.20 on $5, that's over 20% gain on that requirement that you'd have there. Yes, on a risk-reward basis, you can lose 380 versus 120. From that perspective, it's not great, but time's in your favor, and the percentage gain, should Amazon stay above 215, not bad.
Yeah, and just looking at it in this regard, you mentioned if you wanted to, if you're bullish and you use that same July 25th cycle and you bought maybe the 225, 230 call vertical, that's going to cost you a debit, and you're going to need to move higher. This type of strategy, you don't need to move higher. The stock can remain where it is. It can go lower, remain above that break even of 213.80 and still be profitable on it. So there's the trade-offs and the better probabilities of success by selling the out-of-the-money put vertical. All right, great breakdown of that strategy for us. Thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research, for joining us. But coming up after the break, we're going to be joined by Landon Swan from Mike Bolio for a look at sentiment data in Starbucks. The coffee retailer stock has bounced about 25% off of those April lows as the new CEO's turnaround plan continues to evolve. Stick around.
Take a lot of work. A lot of work.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing
Technical difficulties.
Carl.
Schwab, a modern approach to wealth
It went to
management.
90 cents
Whether
and
you're an
jumped back
experienced investor or just
to
getting
130
started,
just
Schwab
now.
offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different
That's the
market
6285s.
techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. That's going to be Landon Swan. He's a co-founder of Likefolio. Welcome to the show, Landon.
Thank you, Tom. Great to be here.
All right, so we're talking Starbucks, the new CEO, in the midst of this turnaround story. It's been, a rough, choppy trade over the last couple of years, but that's because of decreasing sales and, maybe consumers spending less. And then overseas, you've got some issues in China. Also, what kind of data are you guys seeing? Because I've been watching what the analysts are saying, and they're all saying that this turnaround story is taking place, but I don't know if I've seen it yet.
Yeah, I think it's an interesting expectations play. They got upgraded yesterday, I think, a new price target of $100 from one of the researchers. Institutions own 83%, 5/6 of this company. So that's a big factor. But
yeah, it is.
If you look at last quarter, they missed on revenue, they missed on earnings. Their net income dropped by half, down 50%. Their margins are under 7%. Same store sales dropped a point and 2 points in the U.S.
You want to buy this?
And it's actually their fourth quarter in a row of misses. And I think a lot of people are betting on Brian Niccol, and rightfully so. He did fantastic with Chipotle, and I would guess that he's going to do well, right? When you look at his plan, he's talking about back to Starbucks. He's prioritizing better labor, friendlier people, better processes with the way that people handle things, as opposed to making everything super automated. Not that he's anti-tech. He's not. He's talking. He's adding order sequencing that's cut times by two minutes, cut wait times by 2 minutes. They're streamlining the menu, getting rid of some of the under-ordered things and letting people focus in on the higher margin stuff. Increasing marketing, and then of course
there they go, 6285s at 160.
Ceramic mugs, more premium seating, some more free refills. So kind of what brought them to the point where they were super successful. And they moved away from that, and so he's bringing them back. I think it's a smart plan, but I think when you look at what happened with the tariff talk, the stock dropped a lot, and then they had that last quarter earnings report. It dropped, but not as much as you might have thought it would drop. When those numbers I just went over, you thought it would drop more, and I think it's starting to kind of get priced in that it's pretty low. He's going to turn things around. Everything's going to be fine. Just hold and wait. And that's starting to scare me a little bit, because when I look at the data, it's just not there. It hasn't started yet. I like the plan, but when is it going to start getting traction? And he's, rightfully so. The CEO said that EPS is kind of, I'll paraphrase. He basically said it's short-sighted to look at that. We've got to bring back the customer experience. But you can see on this chart, digital traffic with Starbucks. You don't want the one at the bottom at negative 26%. That's tough. We threw in a few comparisons there.
That's real tough.
Dutch Bros is, I'm telling you, that's the up and comer. We've been on that stock for a year, up about 70% on it. I think if you want to play coffee, the ticker Bros is the way to go. And Starbucks, I get the trade on Starbucks. It's undervalued. He's going to turn things around. It's kind of become an underdog with 5 quarters in a row of slipping. But when is it going to take place? And if enough people start to believe that that's going to happen, it becomes priced in. And then if it doesn't, you got a really ugly trade. So I think that patience is warranted here, but the longer it takes, the more iffy it gets. And I think there's better places to put your money.
Yeah, that's that's one of the biggest concerns, I think. This isn't like what Brian Nickel did before with Chipotle and with Taco Bell. They were ripe, for innovation, right, in that space. Starbucks has been around. It's a big ship turning in the canal and trying to change direction for this company. And then you'll start looking at the price points here.
That is true.
That's one of the big things, inflationary pressures that everybody's been talking about. The consumer kind of pulling back on discretionary items for a little bit. Is that going to be come into play? Because Starbucks is never going to lower the price of their drinks, right? And when you go and get a drink and it's $6-7, two people, it's $15-20. If you get some food or something, that becomes a concern also. Is that what you guys see when you look at data? Is once your sentiment, radar ticks off and says, oh, I'm not going to go to Starbucks as much as I used to, and then it's hard to bring that back just because there's still that cost element in there. And if the experience, while it might be better, it's not going to be life-changing again, right? Because this is an established company, and maybe those numbers that you mentioned as far as your data goes, they don't come back as fast as maybe some of these investors think it might.
Yeah, you're exactly right. It takes a long time to turn that consumer experience, which is why companies have to be so careful. They have to guard that so well. And I think that's what got Starbucks in trouble. They moved away from what got them there. It's basically they took the small coffee shop and cloned it nationwide. And you knew what you can order everywhere. You got your favorite drink, and if you went to one location to another, you knew that it was going to be the same, but it had that small coffee feel. And they moved away from that, and he's trying to get it back, which is smart, but it's going to take a while. And in the meantime, people have been checking out and discovering other places. And once you kind of lock in, it becomes a habit. It's hard to break that habit. So it is a very slow ship, not just to turn the company, but to turn the consumer experiences. And I think that's what investors are starting to realize, is that, this isn't, hire him and 2 quarters later everything's great. It's going to take a little bit of time. So that's the main concern. And again, the stock is kind of priced. It's starting, I think, to price it in, and that's where you get, I'm a contrarian. You want to always be a little bit against the grain, so that when something happens that people don't expect, it moves in your direction. So I think we're starting to get to the point where a lot of institutions, I talked about 5/6 of the money in Starbucks as institutions, a lot of them are saying it's going to be fine, just wait it out. But the longer it takes, you start get a little confidence shaking there. Could be a problem. But to your point, they're not going to lower prices. The margins are 7%. You would think it's higher. They're selling coffee and sugar, but it's a lot to put these products out, and with tariffs and everything, that inflation and labor prices going up, they're just not going to have that room. So they have to win on experience, which is what they're going for. They got away from it. They're going back to it. How long is it going to take? That's the question. But again, while I do think this is probably not a terrible buy here in the mid or lower 90s, I think there's a lot better places to put your money.
Yeah, in your data, the web visits versus the stock price, where we've seen a bump up in the stock price. You got some activist investors in there, Elliott Management, Starboard,
boom,
also in there. Also, so that kind of piques investor interest, but they better change their rewards, because you used to be able to get a free drink after maybe a couple weeks of drinking it. Now it's like, I don't know, you can barely use any points. You're not going to get anybody to come back unless you increase that rewards. Maybe I'm speaking from experience there, Landon, on that
sounds
one.
like it.
Yeah. All right, great breakdown for us, Landon. Have a great weekend.
All right, happy Independence Day. Thank you.
Yes, thanks. All right, that's Landon Swan, co-founder of Likefolio, breaking down the data. And he has Starbucks. It's made some inroads from those April lows, but their data, it might be a wait-and-see type of story. And that sets me up for our example trade here in Starbucks, with the stock up about 25% from those April lows. So I looked at a strategy that, hey, maybe it's one of those wait-and-see type of strategies. Maybe you want to own the shares, but you want to maybe collect some yield while you hold those shares. to maybe wait for that rebound. So I looked at a covered call strategy in Starbucks. Now they report earnings at the end of July on the 29th. So I want to avoid that earnings event there. So I looked at for every 100 shares of stock you buy, you can sell an upside call against it. I went pretty tight on this one, about the 96 strike call. So basically about $1.50 above the current share price, so not too far above it. Every 100 shares of stock you buy, you sell one of the July 25th weekly options that expire in 22 days, the 96 strike call.
205.
So it creates this covered call strategy. You're paying roughly about a 92.40 debit. So what, in essence, you're buying the shares, but you're buying them at a discount because you're selling that out of the money call to the upside in that July 22nd weekly. The debit you pay on this is going to be your risk also. You got about $9,240 in risk. So there's a lot of risk, right? Because it's capital intensive because you're buying the shares. But the break even on this is also at that 92.40 level. So you're buying it at the shares at a discount, like I said. Now, as you get closer to expiration over the next 3 weeks, you'll have that opportunity or potential to roll or adjust that short option. And the hope there is that that you collect credits, right? And you reduce that break even, increase your potential profitability on this one. You do have that risk to get your long stock taken away if the stock runs up through the 96 strike
220.
and you remain short those calls. So keep that in mind on this one. Now, why do the covered call? Well, if the stock does pay a dividend. It's about 2.6% dividend yield on this. If that continues to get paid out, there's the yield that you would collect on a quarterly basis, right? But then also the ability to roll or adjust those short options continues to create yield for you also. And as I mentioned, increasing potential profitability. So this might be one of those strategies. It's a you get paid to wait type of strategy. And even if the stock consolidates here, maybe goes a little bit lower, maybe goes a little bit higher, you cap out gains on this type of strategy, but you're creating yield by selling calls and being able to collect that potential dividend. So a good look at the cover call strategy, kind of setting up with what Lightfolio brought us as far as data goes. All right, we're going to take another quick break. We come back, we're going to take a look at Oracle. The cloud stock is at record highs today after the company expanded its Stargate deal with OpenAI.
I guess that's a big deal then. Coming back down again. Man, there's a lot of volatility in this price action. $62.85s. Here we go again. The 62.85s. Calls. Lotto. This is where we need it to hold right here. And we broke below 63 3 different times. So we need it to show some respect. buck.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
95 cents.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Oracle, let's get a quick market update as stocks have extended those gains to all-time highs for the S&P 500 and the Dow. The benchmark is up nearly 0.9%. The Dow up over 370 points. The NASDAQ 100 up about 1% on the day, and the Russell 2000 up over 0.8% as we hit record highs. The S&P 500 and NASDAQ 100
Okay, we're still above it.
high. You can see the heat map here. A lot of green on that screen. All 11 sectors of the S&P 500 are positive today, led by information technology and financials. And one other item of note, the Dow Jones Industrial Average only 0.5% below its record highs. Parabolic moves here. Overbought conditions on a technical basis for a lot of the or for the major indices, but at the same time, the momentum continues to the upside. All right, let's get into a discussion about Oracle.
Oh, hell.
Stocks hitting record highs. They announced the expansion of their
That
partnership
wasn't too smart.
with OpenAI on their Stargate project here. Some more investments. Let's bring in George Tillis, Senior Markets Contributor here to
I
talk
might get right
Oracle.
back out of
George,
these.
Nothing's
We
going
only got a
wrong
few
for
more minutes
Oracle.
left.
This legacy tech company is knocking it out of the park. Their backlog of orders is in the over $100 billion right now. So the AI play here for Oracle seems to be working out well, but this thing's getting stretched on a technical level.
It is, Tom. I mean, ever since the earnings announcements, just going back to June, the stock has made a remarkable run higher. And, it does look a little stretched from the standpoint of the parabolic move we're seeing in Oracle. But, at the same time, you have to consider some of the growth metrics for Oracle and also the
No, we didn't hold support.
cloud infrastructure-based products that they offer, everything from human capital management to enterprise resource management. And you have to think of Oracle as really like a central processing software, effectively the middleware or backbone to enterprise software. And the other thing about Oracle is they've been making a lot of impressive movement into autonomous workloads when it comes to manufacturing, supply chain procurement. So they've expanded their software offerings horizontally, and I think that's essentially what we're seeing with the price actually manifesting some nice returns. I think over the last year, the stock is over 60% to the upside, up 40% on a year-to-date basis. Been a remarkable mover. I mean, it's pretty
95.
pretty large company now. If you look at the market capitalization, I was surprised to see it close to $700 billion. So we talk about the mega caps, and we forget some of the other periphery players like Oracle, which is becoming much like a large mega cap company. Partnerships recent, which include, of course, Amazon Web Services, and the other one compelling is the OpenAI partnership, the Stargate consortium. And with that said, too, some of the analysts are still bullish. TD Cowen recently upgraded the stock. They maintain a buy rating with now a $275 target versus $250 previous.
George, when you look at this, is this about the AI infrastructure build out? It seems like Oracle, the more I kind of dive into the basics and fundamentals of this company, is Oracle is there to kind of mesh all the AI infrastructure build out together at this point, right? And, all their customers right now are Fortune 500, companies across the globe. So as this AI infrastructure investment and build out continues, Oracle has to be a part of that. And I think, is that the reason that you're seeing maybe the valuations going up, where they can actually, if those growth rates continue to expand, that they're going to be able to support the higher valuations that we're seeing for this company, just due to the necessity that Oracle has within AI at this point?
Yeah, I mean, I think I have a couple. I want to add another company here, Tom, just quickly. In terms of these special situations, Broadcom, another one. I think Oracle is especially special because of its software position. Broadcom has application-specific integrated circuit technologies, which are specific to unique applications needed by, of course, hyperscalers and the AI infrastructure. But from a software standpoint, I think Oracle is the mainstay player to integrate the backbone for all of these applications, whether it's cloud security, database management, enterprise resource management, human capital management, and even, like I said, supply chain logistics is another area that Oracle is blending into. Database management, remember the Cerner acquisition, so it gave them access to the healthcare system and healthcare data management networks. And so with that said, I think this is really in such a large company.
Right
their
there.
presence is so profound. To integrate all these technologies together, you need a central processing software. And that's where you have to think of Oracle as the central processing or a backbone software to enterprise. And with that said, you're right. If you do look at the valuations, now in context, if you look at the historical earnings multiple on a 5-year average, it's around 18 to 19 times. Right now, based on this year's earnings, 34 times, and next year's 28 times. So it is rich based on this year and next year's EPS estimates right now. But at the same time, the growth rates are nearly double their 5-year averages. And if you look at some of the rates I'm talking about, revenue growth rates in the last 5 years around 6%. They're expecting 15% in the forward 4 quarters in earnings growth. And this is important because in the last 5-year average, 7% earnings growth. Now they're expecting 16%. So those two metrics, both in sales and earnings, are expected to be basically double the rate of change that they were in the last 5 years. So perhaps, again, this is where I say perhaps, that earnings multiple, which is essentially about 1.5 times their historical average, may be justified. All else equal, they have to, of course, hit their numbers and then, of course, guide higher on a forward basis.
Yeah, valuation's getting stretched here a little bit, but as they get more partnerships, is that one of the keys here, George, real quick before I let you go? I got about 30 seconds. Is that one of the keys here is the partnerships as they continue to expand those because the necessity of what they do in the AI infrastructure build out?
Yeah, I mean, I think that's critical. I think for Oracle, this is what they're doing. They already have such a large presence in the Fortune 100, even the Fortune 500 companies. Like I said, as a central enterprise resource software. But the new partnerships are establishing, and even added to that, you know, with OpenAI being primarily capital invested by Microsoft from a founding standpoint, you know, Oracle's just adding more partnerships where it's OpenAI, Amazon Web Services, Microsoft. The growth trajectory is still there, but the other thing is they're such a cash cow too. They're already making tremendous amounts of free cash flow yield, and now on top of that, you're adding growth. And so these are two, you know, quite powerful financial variables that can keep the stock going. But
there's 6 more minutes, 5 more minutes.
Stock looks a little bit extended, and it typically has these, you know, stocks. Every stock has its own personality, but this one typically has these sort of powerful moves, both up and down. So that's something to be mindful of as we move into the summer months.
All right, great breakdown for us, George. Appreciate it. That's George Sillis, Senior Markets Contributor.
Well done, George.
Here on the network, breaking down Oracle, positive, and if you look at the stock, the parabolic move, relative strength index, or RSI, is above the 80 level. So overbought. Anything above the 70 level is considered overbought. It's overbought on a technical basis. It's above its 50 and 200-day moving average. The 50-day moving average is $174. This stock's trading $236 at this point. So we got a bonus. We got 2 trades for you to look at here. And, you know, these are just example trades. If you think this thing is maybe overbought, this is a strategy that may take advantage of a potential down move in the shares. So the first one that I'm looking at here is out in the July or the August 1st weekly cycle. So you've got nearly a month in this position here, 29 days till expiration. Because implied volatility levels are really low, the IV percentile rank about 37%. So we're in the bottom 1/3 of what we've seen implied volatility levels over the last 52 weeks. So this strategy takes advantage of that lower implied volatility because it's cheaper to buy a vertical in a low volatility environment. So going on to that August 1st weekly cycle, 29 days to expiration, we're going to buy the 235 put. It's basically at the money at this point, just slightly below the current share price. And then against it, because we want to offset some of the costs and make this a spread, we're going to sell the 220 strike put. So a bearish $15 wide put vertical to the downside. You're going to pay roughly about a $5 debit for this $15 wide vertical, right? So risk reward setup's pretty good. You're risking $500 to make an extra 1,000, right? If this thing expands to $15 on this if it goes below 220. So the debit you pay is going to be your risk, as I mentioned, $5. Your break even to the downside, $230 or $230. That's about $6 below the current share price. So you do need a move on this type of strategy. But one of the keys with this one is it's a bearish directional example here, but you've got some flexibility as far as trade management.
This guy talks way over my head.
If you get the move you want ahead of expiration, maybe over the next week, maybe over the next 2 weeks, but before expiration, if you're doing multiple contracts, you can maybe close a portion of them, close the whole thing ahead of expiration if the market's open and liquidity's there. So that gives you some little bit more flexibility. If you think this stock's overbought, this is maybe a way that you can use the option market to get some exposure to the downside if you think maybe it's going to pull back. But you do need that move back below 230, that break even. Now, let's flip the script here a little bit. It's still directionally a bearish example that we're going to look at with this next trade. A little bit shorter duration too, but we're also going to give ourselves better probabilities of success. On the bearish put vertical that we just talked about, you need a move to the downside, right? This strategy, I'm going to flip it. We're going to do the call side, and we're going to sell a call vertical here. And this is going to be out in the July 18th monthly options that expire in just a couple weeks here. We're going to sell the 240 strike call, and then against that, because we want to stay risk defying, because the stock can still continue to move higher, we want to protect that short call there, buy the 245 strike call, all in the July 18th monthly cycle. You're going to collect roughly about $1.50 credits, probably trading closer to $1.75 right now. You can collect a little bit more. Stock has moved higher. But if you collect that $1.50 credit, that's what you can make, $150 per spread, with $350 in risk on this position, right? So here's the trade-offs, right? On the long put vertical that we bought earlier, $5 to make another 10, right? On a $15 wide bearish put vertical. Here on the call side, it's a short $5 wide call vertical that I'm only collecting the $1.50 on with $350 in risk. So those risk, the profit and loss kind of flips on these. But what's the trade-off that we always talk about? In that July 18th cycle, where you're selling the 240 strike call, that's got about a probability of 57.5% that it'll be out of the money at expiration. Now, collect that $1.50 credit. Where does it take your break even up to? 241.50 to the upside. That'd be a new fresh all-time high to get through that break even on this one. So it's a little bit more conservative. You profit in 3 out of 4 scenarios on this one, right? If the stock goes lower, stock stays where it is, or stock goes higher but remains below that break even of 241.50, you can be profitable on this type of trade. The other put vertical that we bought, as an example, prior, that was one where you need a move, right? There's only one scenario where you profit in that one, and that's if the stock moves lower. So those are those trade-offs that we always try to instill in our viewers and traders at this point. So those are the things that you look at. You got the double bonus package here on Oracle with 2 different ways to look at maybe a bearish example here in Oracle. Why don't we go ahead and get ready here for the closing bell. Stocks have come off of those session highs, but we're still in the green. The S&P 500 at record
ding,
highs.
ding, ding, ding.
At record highs as we close out a spectacular week for stocks.
Well, it was a week, all right.
So far this week, up 1.7%.
Hold on, more or less.
Up about 1.5%. The Dow Industrials
sit there for a long time and be bored.
3%, just 0.5% below those all-time highs. The Russell 2000 up 3.5% so far this week.
Damn.
Now only 8.8% below its record highs. So great week here for equities going into the long holiday weekend. Everybody, thanks for joining us here on Fast Market. Be sure to download the Schwab Network app, available in the Apple App Store. Tune in 24/7 on SchwabNetwork.com. Have a great 4th of July weekend, everybody. USA, USA.
Welcome to Schwab Network's Market Overtime. I'm Diane King Hall. Our guest today knows what it takes to lead, whether it's on or off the field, protecting the league MVP quarterback or making smart financial moves. He's four-time Pro Bowler, key force on the Buffalo Bills offensive line. He's also making plays in the financial world. Dion Dawkins, a.k.a. Schno. Welcome to the show.
Yeah.
That's right. I love it.
To the show.
There we go. I heard, and actually, so.
No, what it's. What the hell is that? I don't know what that is. Okay, well, I'm out of here.